Good morning, everyone. Mr. Roy has just arrived, so we'll be starting the session in a few minutes. Thank you, Mr. Roy. We are commencing the opening session of Financial Market Conclave with the theme Indian Financial Markets, Partnering Growth, Empowering Masses, Connecting India. I would request our President-designate, Mr. Arnab Basu, an advisory leader, PricewaterhouseCoopers Private Limited, to kindly come up to the dais, sir, and kindly deliver the welcome address and way forward for us.
Good morning, ladies and gentlemen. It's a privilege and pleasure to be here on behalf of BCC&I and welcome you all today to this edition of the Financial Market Conclave. Over the years, the Financial Market Conclave has become a signature program of the BCC&I as we do different programs with different industries across the country. And the theme of today's conclave is Indian financial markets, partnering growth, empowering masses, and connecting India. You would see that these three aspects are very, very critical for today's world. We keep talking about growth, but we also have to think of inclusive growth. And if we are not looking at inclusive growth, it can lead to, disruptions, which we are well aware of, and hence inclusion and empowerment are very critical. And of course, a lot of it is around connecting India today. And we have seen a lot of connectivity coming into the FS space. Our financial sector has probably been far ahead of some of the other sectors. But we are really thankful today to our esteemed speakers, and I see many of the speakers have already come for their time, for them to deliberate on some of these topics. As I said, that I'm not an expert, but we have a panel of experts for you. The Indian banking industry, I would say, has recently, witnessed rollout of many innovative banking practices, banking models, digital payments, small finance banks, and we have a very august gathering of senior bankers. And of course, we are expecting Mr. Shetty to talk to us as the head of the largest bank in the country. And in recent years, we have also seen a lot of focus of the banking sector on, different schemes around the government schemes like the Pradhan Mantri Jan Dhan Yojana, the post-payments schemes. Schemes like these, coupled with major banking sector reforms, I would say we've seen a new era of banking sort of come up over the last few years. And I do think that if you look at financial inclusion, the way India has been able to do using tech, I think this is something many countries would probably learn from us, and it will help fuel the credit cycle growth that we really want for our sector. I know that many of us are very keenly looking at what the Fed does tonight, but I do think that this is something which finally we'll have to look at a forward-looking, growth-oriented momentum which the sector needs. And if you look at the interest income of public banks, it's in excess of 100 billion, and private sector banks in excess of 70 billion in 2023. So that gives you an idea of the reach and the potential of this sector to really make the Viksit Bharat, which our Prime Minister has been talking about. If you look at the other sectors within financial services, our enhanced spending on infrastructure, speedy implementation of projects and continuation of reforms, these are very, very important for us as a country. And it needs to be, fueled to, sort of keep the growth momentum going. And all these factors suggest why this sector, the banking sector, along with some of the others around insurance, around mutual funds, would have to really play a very, very significant role in, the robust growth that we all aspire. And I do think that there's a lot of emphasis you will hear from the speakers today also, that when we look at the services which are being provided to us, all of us are consumers in some way, and how these services are being provided to clients, I think that's seeing a lot of new initiatives. The level of service has been upgraded across most banks, and their investments in tech infrastructure to ensure that the overall customer experience is growing and becoming far better is something which we have all witnessed. The Indian mutual fund industry has also experienced immense growth, and again, if you look at the kind of SIP payments which have been going in, SIP investments, the numbers are staggering, right? And sometimes when you talk of these numbers, 2 lakh crores, you keep wondering how many zeros you have. But the money flow into mutual funds seems to be unending. And I think, according to Goldman Sachs, the investors have been pouring money into the Indian stock market. And I do think that the Indian stock market very quickly will surpass the UK stock market and become the 5th largest stock market in the world this year. The capital market firms, obviously, they need to constantly adapt to industry trends to stay ahead. And I do think that new tech like Gen AI can help achieve this. If you look at domain-specific large language models, I think what they are being able to come up with as solutions are very, very, specific and significantly better than OpenAI models. And we have seen a lot of players in the industry adopt them. If you look at the insurance sector, the insurance industry is, of course, experiencing very, very strong upward growth. It's been about 30-35% growth on a regular basis. But I do think that when you look at insurance as a sector, there has to be a lot of focus on how do we look at insurance for all. And I know that the IRDA has taken up a target to get everybody insured by 2047. If you ask me personally, I do think that 2047 is very, very far off. We need to get it done much before. And there has to be aggressive plans by the sector and by the government to address this much before. And many of these cases, I think, if you look at AI and its related technologies, they do have a seismic impact on how, the insurance industry, right from distribution to underwriting to actually, pricing the claims, all of these can benefit a lot using new tech, and digital will become, even more core to what we are doing in some of these things. And when you look at advanced technology and data and what they're doing, I do think that, the world has to see an explosion of what are some of the options which would come. But I would not take too much time today. As I said, I'm not an expert on some of these sectors, but we do have an August gathering of, sector experts who would come in. So again, ladies and gentlemen, I wish you a lovely day today of learning from each other, learning about what clearly some of the leaders are thinking in the industry. And welcome once more. Thank you. It's our pleasure to have you all here. Thank you.
Thank you, sir, for setting the tone. I would request Mr. Jaideep Kumar Rai, partner at PwC India Financial Services Advisory Leader and member of the National Bank and Finance Committee of the Chamber, if you may kindly join us, sir, and deliver the address and introduction. Thank you.
Thank you, Arnab. Good morning, and it's always a pleasure to be at the Bengal Chamber events. The last few events have been in other cities, Kolkata especially, but I'm so glad that the session has moved here, especially when it's a financial conclave, and where else to have it but Mumbai. The theme is very interesting. It is about empowering masses of India by connecting people on financial matters. And I think you're going to hear a lot of interesting deliberations during the day, especially focusing on the 3 pillars: banking, insurance, and stock market or financial markets. There are many initiatives, and you just heard from Arnab Basu on certain expectations of the market. Whether it is a time-bound expectation or whether it is an extensive expectation of depth of the markets, India is progressing well compared to the time when, let's say, when we used to be considered not a major or a significant player in the world market. As we go towards a $5 trillion economy and look forward to be the third or fourth largest economy in the world, certain things always keep holding us back. And we need to understand what are those two so that the combined might of the financial markets coupled with some of the other very key sectors work on those. One of the things that really prevents the whole spread of financial, or the spread and the utilization of all the financial services across the country is a trust deficit. When we think of the masses, when we really reach the masses, at every step, we start fighting a trust deficit, whether the money is safe, whether money is being utilized well, who is taking the money, where's the money being put, what function, if it's an insurance claim or if it's a stock market investment. So I think that's something to be worked on. The trust deficit works on two counts. It works on understanding of the instruments that are available and also financial security. So education of people and institutionalization of certain processes is important. For example, if I look back 30 years back from now, the Indian stock market was in an absolute shambles. There used to be huge delay in settlements. No one knew how to handle the paperwork. It was not standardized. Everything changed with dematerialization and standardization of the entire process. Now that was made compulsory. It wasn't left to be an additional layer as NSDL was formed and dematerialization of shares that introduced it brought down settlements first to T+7, then T+3, then instantaneously. So that has made our stock markets reliable, and people do participate with a degree of confidence. Participation is still a problem. Retail participation is still an issue, and I'll speak about that in a moment. But if you think about banking, check clearances used to be staccato. Now, once the switch, the entire NEFT switch, it was institutionalized, it has become certain. It is not 99.9999%, right? It is 100%. So there is an absolute certainty across the entire banking industry that if you actually send money, I'm not even talking of UPI or anything, but imagine the simple act of a check clearance. It is standard. It answers to the expectations of someone who puts in. The money happens. Money does flow in. You now take it for granted, don't you? It's like how you expect lifts to run or car to run. You expect the entire system to run. You don't think about which bank you are in, which city you are in. So I think that's the kind of certainty. 100% certainty on customer service has to be brought in. Even in insurance, which is more complicated because products are different, but still 100% certainty on the transaction process of application and claiming has to be brought in for trust deficit to go. And without this trust deficit removal, however much we improve systems or regulations or make it enabling, etc., people will hesitate, especially when we talk of connecting the masses of the country. The second thing which we have to think about is ease of doing business. Across the financial markets, ease of doing business has to be thought of, and it has to be thought of at one standard. It cannot be different from different financial pillars. It can't be different for example, if with today's maturity of KYC, do we need wet signatures on something? Do we need 52 signatures on a on a loan document or somewhere else, or an insurance proposal. Why would we need that? Demat account opening, how can we simplify that? How can we make it like, that once you have the KYC, it should be done. So while we have been working on this entire digital India stack, and India stack is powerful. Anybody who has done Digi Yatra would know that getting your data and empowering yourself in your own hands, it's so easy. Why can't we have that as a standardized process everywhere? I think standardization creates trust, because it creates once learned, you know how to deal with everything. And that's what is an important factor. As we talk of technology, the other fear is about internet and cyber security. Every day, thousands and thousands, why thousands, tens of thousands of incidents are happening. Some are successful, some are not successful, some are actually physical, techno-physical, some are entirely technological, but there are attempts of financial crime which are happening. Now, financial crime is not different from any other crime. We can't just keep policing afterwards. Huge amount of education is required, consumer education, no doubt, not to fall prey or not to keep themselves open, not to keep their important documents and KYCs all floating all around all kinds of media, because there's a surfeit of media. But also, there has to be some amount of layering of security. People can enter. It's human ingenuity. Cyber security is a question of human ingenuity. However advanced a lock you can put, there's another human who's figuring out how to break that lock, correct? So locks will be broken, securities will be breached. But how do you make sure data still remains secure? People can't just escape with the data or utilize it in another financial transaction. So that kind of thought process has to come in, so that people feel secure. People feel that even if there are attempts, they would be still willing to do business online and connect, because that's the only way to reach the masses. The other point which has to be understood is financial markets, the financial services as a whole, it's an enabling industry. It enables other industries. It enables the accumulation of money from various sources to be disbursed into other utilization, areas of utilization. It matches buyers and sellers. It matches demand to supply. It matches a lot of retail investors to institutional borrowers. It does match people who want to secure their future to somebody who needs it. It does match someone who wants to sell a share but doesn't know where to go to someone who wants to buy. Somehow it matches them. So financial services also works on thrives on the maturity of the rest of the market. If financial services has to support the economy, if it has to reach the masses, empower masses, certain other things have to be taken on priority. The government already has those on priority, but I'm just saying that the pace of growth of those industries have to be really, at a much higher much higher level. The four important industries in this case are transportation. Without transportation of goods and services, money also does not flow. And money, if it does not flow, does not create economic value. Sanitation. Sanitation with Swachh Bharat has reached some place, but sanitation at a much lower level. India still has the largest amount of open defecators in the world, and that has to be addressed everywhere. Tourist places, places of business everywhere. Third is safety. Overall safety of citizens, and that includes the feeling of safety, which means prevention, as well as addressing areas and situations. And lastly, healthcare. Ayushman Bharat is here today. It gives 5 lakh rupees of spending ability to every family below poverty line, and that should have resulted in many thousand hospitals springing up everywhere, but it has not happened because we do not have enough doctors and nurses. We can buy the medical equipments, but we don't have doctors and nurses adequately in the country. We do not have adequate procedure, protocols. So while we might have great healthcare due to which medical tourism happens in a few cities in the country, but whenever we are talking of masses and connecting them, we must make sure that, and I am not even talking about education, which is a much larger subject, but transportation, sanitation, safety, and healthcare are the 4 areas which need enormous attention for people to participate in the financial markets, for money not to be lost and money not to be stolen and money not to be misutilized or even lying idle. So you have a whole day of deliberations, and there are very astute, erudite speakers who will come and talk to you. There are on sessions which will be the moderated sessions as well as addresses. And I think this is something which would be my expectation from the sessions, and I'm sure all of you will be looking forward to those. Thanks again for coming. It is again a great pleasure to welcome all of you to this day of deliberations. Hopefully some certain key and decisive points come which can be relayed on to the respective authorities. With that, I wish you a great day ahead and declare this session, the morning, open. Thank you.
Thank you, Mr. Roy. I would now request Mr. Tamal Bandyopadhyay, eminent journalist and writer and mentor of Finance and Banking National Committee, to kindly come up to the stage, sir, please, along with Mr. Dheeraj Relly, MD and CEO, HDFC Securities Limited, Mr. Madhav Nair, Country Head and CEO, Bandhan, Bahrain and Kuwait, Mr. Venkat Chalasani, CEO, Amphi, Mr. Sachindranath, Founder and MD, Ugro Capital. I'm just, with this, we're just requesting Mr. Bandyopadhyay to kindly open the session.
Very good morning and welcome to the first show. And thanks particularly Arnab Basu for setting the context. And then of course it was carried forward by Mr. Roy. So this is all about India's growth story, how do we move forward, and underlying theme is inclusiveness, so inclusive growth. We have a very well-crafted panel. I wish had there been a representative from the insurance sector, you would have said you would get a 360-degree view of what's happening in the Indian financial sector and markets. But still, I mean, we have a view from the ground realities. These 2 gentlemen around on my left and right, they represent markets. And in fact, just before coming here, we're talking, what do we talk? We are saying that market talking itself, what do we need to talk more? So that's the market story. And then we have a banker and we have a non-banking financial sector. Banking also, every quarter you see this better than the previous quarter. And NBFCs had issues, but I think the days of ILFS and all, it's well, we have passed them. I mean, we don't look back, things are much better now. So I'll speak the least. They have come to listen to you. We have 55 minutes. We are running about 15-16 minutes late started. So we'll stick to not more than 55 minutes. We'll take questions also from the audience. So Arnab, if it's possible, keep the mic there. We don't necessarily need to wait till the end. Maybe a couple of questions for your involvement. So we'll start, Dheeraj, with you, and then followed by you, the markets, because that's talk of the town. What's happening is irrational exuberance, or it's really things are in place, the economy and financial sector and corporate India, what's happening is justified. And the underlying theme is this, those days, many years back, the FIIs were driving the markets. Then we're talking about the DIIs were there, LIC and others, and now it's the retail investors. If you see every day the market movements is the retail investors, and that what I'm talking about is not to discuss any theory, the inclusiveness, which is the theme of this thing, inclusive growth. So finally, even the retail investors, or to a large extent, have found out that market is a asset class which was not on their plate. It's sort of the bank FDs and at-based mutual funds. But now it's, of course, mutual fund is doing, phenomenally well. But everything is now driven by the retail investors. So that is the inclusiveness. So tell us, Dheeraj, to start with.
Good morning. Good morning. Thank you for having me, Tamil, and thank you for setting the context. I think we are in the best of the times for the capital markets. So being there in the market for last decade or more, I can't complain about the market environment. In fact, we are really buoyant about the market environments. I think you've rightly started that, India with 1.4 billion people is a very large country, very diverse country, and unless until we have an inclusive growth in India, you cannot become a rich or a probably affluent country. So in last 20-25 years, what has played out is, I think, assimilation of technology. We started with the Y2K, before that some, movement where PC started to come to India and so on. And after that, we've really adopted the technology significantly. We all know the payment story. We all know the Jan Dhan, Aadhaar, mobility, the penetration. I think it's all attributed to the culmination of Jam Trinity, as well as the need to be more inclusive from all participants, including the government also. We've been driving in India financial inclusion since independence. But till we made it viable, it wasn't possible, it wasn't happening. It was always been an agenda for the government, it's always been an agenda for the bankers and capital market participants, but it had to happen, it has to be a viable proposition. Once the technology came into the play and inclusion became possible, we are seeing now participation from the retail investors. Just to substantiate what I am talking about, the participation with some numbers, today we have 17 crore demat accounts. Today, in last just about 16 months, we've added 6 crore new demat holders. And we are adding 4 million customers every month, new demat accounts. So this talks volume about it. I think Mr. Roy was talking about ease of doing business, and why are we taking so many signatures? If you have a KYC in place, it should be easy. I can give you an assurance that today we are at that juncture in the industry where for us at HDFC Securities, 98% of our accounts we open through the digital journey, which gets completed in only 5 to 6 minutes time only, and no paperwork at all. 100% digital journey to start your demat trading account and link it with the saving account. So that is what made inclusion as viable and possible. This investments, particularly into the capital market ecosystem, was a prerogative of institutional investors and also select individuals, ultra HNIs who had access to the information. Now with the plethora of options available and dissemination of the information through social media, I know we have been dealing with some issues with some freelancers going overboard in this front also. But having said that, the democratization of the information and ease of accessing the information also made inclusion more viable, more possible. So in a nutshell, I think the assimilation of technology, significant effort from the regulators as well as by all participants had made the financial inclusion viable, possible, and we are seeing the retail investors as a large workforce and large participants in India, and I think this trend is here to stay and will continue.
Thanks, Dheeraj. This is the preliminary. Yeah. Thanks. This is the preliminary remarks. I mean, we'll get into some of the detail if it's possible, the time permitting. Venkat sir, you tell us what's happening in the mutual fund segment every day that he spoke about the demat accounts, how the investors are, retail investors are rushing to open demat accounts, etc. And then every month we see that AUM is going up and up. We are, in fact, banks are in private blaming you for taking away money, but that's a separate story. Actually, money comes back from the bank to the bank in a different way. But that's and then your SIP also going up and up. And all this actually shows that the inclusiveness and the presence of the retail investors to a large extent in the market. Have you ever seen this before? What Dheeraj said that this is brick by brick, this has been built over a period of time, and now this is bearing the fruits. So in cricket's parlance, it's the right pitch to hit sixes. That's the kind of situation. So you are the dawn of the market in that sense, boss of Amphi. So tell us what's happening.
Thank you very much, Mr. Kamal. First of all, good morning to all of you, and thanks to BCC&I for giving me this opportunity to be a part of this particular conclave. I was a banker earlier, and then fortunately I came into this particular sector. And this is a very, very interesting sector. And let me put some numbers, put some data points, what Mr. Tamal was talking about to tell you where the mutual fund industry right now is. You know, it started off all in 1964, and it took 55 decades for the mutual fund industry to touch 10 lakh crores. That is, in 2014, the AUM of all the mutual fund industry touched 10 lakh crores. And in 10 years, by 2024 from 2014, our numbers have grown up from 10 lakh crores. As we speak now, it is 66 lakh crores. So more than 50 lakh crores got added. And other important data point that I would like to tell you is, in 2014, what Mr. Tamal was talking about, the AUM was around 10% of the total banking deposits, which Mr. Madhav Nair represents. And today, as we speak now, we are almost 34% of the total bank deposits. 2,30,000 crores is the bank deposits, and we have almost around 66 lakh crores. There is a continuous flow. I mean, again, if you break down what our speakers were talking about, retail investments, 67% of the total investments are coming from the individuals. And I'm also happy to state that earlier the focus concentration was more on top 30 cities, in fact, top 5 cities. Now, as we move forward, the below 30 cities, you're finding more than 18% of the people are coming and contributing to this particular industry. This journey is good. People, the factors, various factors are resulted into it. One, of course, you have very, very strong macros. Two, the technology which we are all talking about. I heard KYC, so many signatures and all. Trust me, if you validate your KYC with one AMC, then you can invest in any of the AMCs. So things are made easier. It's not all that tough that we're talking about. So ease of doing business in respect of KYC. Then, of course, the GDP is growing, one of the fastest growing economy. We are constantly educating. There is so much we can do. Financial aware literacy today, as we speak now, is around 26%, whereas our literacy rate is more than 80%. So there's so much we can do, and we are doing it. We'll talk about it later. Like you would have seen mutual funds, the way in which we are penetrating, going down the villages, educating the people, and investor awareness, everything. Then the other important point that we also have is a digitalization, the technology that we are taking, which is supporting us. Earlier, majority of it used to come what we call as a regular, that is through the distributors. But as we speak now, 35% of the investment is coming through direct, and 65% continues to be on the regular. But again, we'll talk about in the second half why this regular and how we can penetrate more. Today, am I happy with these numbers? Let me tell you, we are very, very happy, but then there is so much we can do. Why do I say that? As we speak now, 4.8 crores of the people are investors. And then you know how many State Bank of India, Mr. Shetty is coming, and then you know State Bank of India alone has got more than 47 crore customers. You have almost around 55 crores of people who have got Aadhaar and PAN card linked. So, and then you have more than around 20 crore of people who are doing online banking, online market. So there is so much that we can attract. The second data point that I would like to also tell you is mutual fund industry, as we speak now, there's a phenomenal growth, but we are only 18% of the total GDP. If you look at an average of the globally, it is 65%. Again, there is so much scope there. So I think I'll speak on the second part of next time as to how we are planning to move towards that particular goal and see that the capital formation and the savers, more and more savers move into investor and take the advantage of the growth of the country. I'll stop there.
Thanks. Yes, yes. Thanks, Venkat. I think things are happening, but the possibilities are endless. That's what I'm saying. It's many more miles to go. So let's hear Sachindranath. Tell us now in that NBFC sector. Again, it talks about inclusive growth, and every 3 months or 6 months, you find that your organization is raising more money and more money and more money. I mean, recently you had one of those, evening celebrations, right? Yes. In one of those hotels in Mumbai. So things are happening, and you're moving at a breakneck speed. So as I said, that the shadow of IL&FS is no more there on the industry. But there at the same time, there's the RBI concerns about the personal loans and retail, etc., etc. It raised the risk weightage in November 2023. Some of the NBFCs, they talk about how the banks are becoming little cautious and or stingy in giving money. That's a separate story. But tell me, in this context of India growth story and it's inclusive growth, so where do you stand? What is your contribution? You meaning, I mean the NBFC segment. And what are the possibilities? Preliminary remarks.
Thank you, Tamal. I don't know, when I have a room full of bankers, anyone says we grow at a breakneck speed, I don't like it. RBI don't like it. So we say we only grow at a moderate speed. It is just a function of our capacity and size that we have achieved almost 10,000 crore in 3 years' time. I was recently, suba ka samay hai, so I'll just lighten up the mood. I was recently in a very, in a gathering which was, all the secretaries, ministers. And उन्होंने बोला ना ये NBFCs ना आप लोग काम अच्छा नहीं करते हैं, आप लोग जाके बहुत सारा ख़राब करते हैं लोगों से, आपका रिकवरी का मेथड बहुत ख़राब है. तो I gave them this example. I said ना कुंती के 2 बेटे थे, एक था कर्ण और एक था अर्जुन. और बेचारा कर्ण गया द्रोणाचार्य के पास, उसने बोला सर मेरे को भी आप ना शिक्षा दीजिए. उन्होंने बोला तुम तो छत्री नहीं हो, तुमको हम नहीं देंगे. तो उसके बाद फिर फाइनली कर्ण टू गेट रिकग्निशन ही हैड नो चॉइस बट ही वेंट एंड मेट विथ कौरव्स एंड वर्क विथ कौरव. सो ऐसे ही हमारे देश में भी है, बैंक्स कर्ण हैं, NBFCs बैंक अर्जुन है, NBFCs कर्ण हैं. तो अगर कर्ण को भी द्रोणाचार्य ने एक्सेप्ट कर लिया होता और उनको अर्जुन से मिला दिया होता तो महाभारत डिफरेंट होती, राइट? तो ऐसा है हमारी NBFC इंडस्ट्री. So, this inclusion, especially in our sector, right? I'll come to your risk weight and risk. But inclusion in our sector, it is time, again, it has been proven that when it comes to inclusive growth, and especially in the credit industry, majority of the work has largely been done by MFI, by Affordable Housing Finance Company, by NBFCs. Sector, if you look at last 5 decades or 4 decades of evolution, there was a point of time, there was a second-hand truck driver could not get finance. Now there is a large institution around second-hand truck financing. For a guy who was self-employed, who could not get a loan for building a house, now they are a large affordable housing finance company. A street vendor could not get a loan, now we have a large MFI as a sector. I'm not saying that banks don't do that job. The structure of the bank in India, the way they are designed, that inclusion as an agenda for banks is extremely, extremely difficult. We have 12 public sector banks. They are driven by government agenda. Government sometimes drive them nuts for many other things, which is also inclusion in some way. But structurally, banks are not designed for inclusion. NBFCs are designed for inclusion. But in that, actually, sometimes, when it comes to the, the risk weight, the RBI is concerned, there is a very large narrative that there is a massive risk which has ballooned up. So what RBI has been saying that banks are lending to NBFCs, NBFCs are lending to retail customer. Retail means consumer, personal loan, and there is a large ballooning of risk has happened. I don't think so that there is any doubt about it, and I don't think so that it is not true. If you look at data, now it is actually improving. There is, so there are two types of lending institution. I keep saying one who are blessed with Lakshmi Patji and one who are blessed with Saraswati. So all AAAs, large corporate owned NBFC, which all banks find very attractive, they keep lending big wholesale money to all the AAAs, and finally for them to achieve the market cap, the price, all of that, they end up doing this small sachet loan at an excessive pace, and that has ballooned, and that's why RBI has been concerned, but that would evaporate. But what is needed purely for inclusive growth is to categorize NBFCs which are in form of inclusion. MFI sector in India have grown because MFI was recognized as a category. Housing became very prominent because it was recognized as a category. Within NBFC, between an NBFC doing massive personal loan, consumer loan, small loan, versus MSME which is doing an MSME loan or inclusive loan, agri, rural, there is no differentiation. So, time has come to recognize the current and make it much closer to Pandavas than Kaurav.
Thank you, Karna, right? Thank you, Karna. I mean, we'll go to Arjuna now, the speaker. I wish somebody from Reserve Bank of India was sitting and listening to you, how you are demolishing the regulator's argument and everything is fine, nothing to be worried about. Good to hear that. So, let's hear Karna now. Arjuna now. Sorry, Karna has spoken. Yes, Arjuna. Tell us, banking sector has never been so good. Like Mr. Kamath, some time back, I think probably last year, spoke about last financial year, spoke about that he has never seen such a banking sector in the past 50 years. That's the kind of thing. Credit cost is historic low, both goes NPA and late NPA, and every quarter is rocking and all. So tell us in the preliminary things, in the context of this inclusive growth, and of course there are structural changes also. Banks are not wooing the corporations anymore for lending. It's the retail, that's even for State Bank of India, you look at the balance sheet, there is a structural shift. So it's for the masses now, the banking system. But first tell us in the preliminary remarks, how is the good run forever, or the Goldilocks moment is behind us, you need to be concerned? Not as far as your bank is concerned, I'm talking about entire banking industry. After that, we'll take one or two questions, and no stock recommendations, etc. Please ask any macro question, but there's two gentlemen sitting here, don't ask where to invest and all. So Arnab Chakravarti, can you keep the microphone there? After him, we'll have one or two questions and come back. Madhav.
Thanks, Tamal, and thanks to BCC for giving me this opportunity. My good friend Sachindra mentioned about Mahabharata. The banker's perspective of Mahabharata is slightly different. We would say that we are Yudhishthira and they are Duryodhan. Okay. We always believe that we are highly regulated and there's a regulatory arbitrage for the NBFC. That's a perception. I'm not saying that's my view. That's a perception. So again, if you take that, I think a lot of connotations can come in on why Sachindra, when he followed up, he said that banks have structures and it sort of prevents them from getting into certain areas. I think that's the key, I suppose. Now, let's look at...
Actually, he said that when it comes to inclusion, only NBFCs do that. Banks are not there. Yeah, relative. He is now putting this relative word is putting that. So Karna actually said that.
Yeah.
I mean, that's how his Ratha Chakra got stuck and all kind of things happen. But that's a separate story.
So I will correlate it with what Dheeraj started off. I think he said that, I think right from our independence 1947, I think financial inclusion has always been there. In the banking sector, we know that the priority sector lending has been something which is there. But again, it's something which is regulatorily mandated for banks to do it. I think where Sachindranath was coming was that there is today an opportunity in financial inclusion where you can make money too. And I think that's what even Dheeraj alluded. There is an opportunity there, and I will quote from C.K. Prahalad, which when he wrote an article which then got translated into a book. He said, "Fortune at the bottom of the pyramid." So I think there's definitely an opportunity there. Now I'll just take a step back and look at what the banking industry has been doing for last couple of decades. If you look at it, and I'll broadly classify it into, say, corporate, retail, and SME. Corporate used to be roughly around 60 to 65% of the banking credit 20 years back. Retail used to be around 10 to 12%, and I think SME also was roughly around the same. Come in 2023, the corporate, like Tamal you mentioned, it's reduced to around 40-45%. The SME has grown from 10 to 12% to around 18 to 20%, and retail has grown from around 10 to 12% to almost close to 30%. So obviously things have changed. There is definitely more inclusion if I look at from one perspective that there is a lot more retail credit happening. Possibly the corporate share shrinking could be that there are other instruments available for corporates, including capital market instruments for them to sort of raise money. Also what we have seen is that we have been talking about private sector capex which needs to pick up. Probably that's taking a bit of time, but I'm hopeful that that will start picking up. So we will see an uptake there. Overall, I think it has been really good. From what we used to call it as fragile economy, twin balance sheet issues, that's got completely converted into twin balance sheet strengths. The bank's balance sheets are extremely strong, and so is corporate balance sheet. So yes, we are truly in Amrit Kal from a banking sector perspective. We can, of course, do a lot more in terms of financial inclusion, the urban-rural divide which I see. How do we use technology and go further in? And I think the Jam Trinity which has been spoken of, the UPI was a game changer, and the recently introduced ULI by RBI, which will bring in frictionless credit. I think these would be the game changers, Tamal. So this will be my opening remarks. Thank you.
Thank you, Arjuna. So any question from anybody? Anybody? This lady will just... oh, no, not this lady, this gentleman, yeah. Ajay, you give this one and then the two. Okay, fine. Ajay, there he has already been given. Okay, fine. Just, sir, quickly, or why don't you just...
Hello.
Yes,
My name is Sandesh. It's a question for an MP director.
Speaking loudly,
My name is Sandesh. It's a question for an MP director. Can you do anything from distributor to increase the distributor from the market?
To increase the?
Thank you.
Distributor, mutual fund distributor.
Thank you.
There are multiple steps that the AMFI and the industry is doing in order to increase the distributors network. As we speak now, we have 267,000 distributors, which includes, of course, 160,000 retail distributors and the remaining corporate distributors. But what we are trying to do is, we are running various campaigns. I think you would have seen the campaign to bring in more and more people into this particular sector as a distributor. 2, we are going across the country. In fact, one of the things that we started doing is adopting some states. We are asking each of the AMC to adopt 2 to 3 states. In fact, AMFI, we have adopted 3 states. And in those 3 states, we're going to go to the colleges, universities, where the people are at the fag end of their education, and then train them, explain to them how to become a distributor, make them write the CAMS exam, and then bring him into the fold. There is also other thing that we're doing is conducting programs across the country in the B30 cities. So our objective, if I were to look at taking this mutual fund industry AUM to 35%, distributors are going to be the important stakeholder, and we are working to move in that direction.
Thanks,
And
Venkat.
of course,
Yeah. It's okay. You know, I'm so happy that the Bengal Chamber has got this inclusiveness, because if you look at the entire industry in financial landscape, the inclusivity is the key, which was essentially started by Dr. Reddy for Reserve Bank of India. That inclusion was the term was coined by him, and insurance industry is now talking about the same adoption of different states by thing, and on the line of SLBC, the state level bankers committee insurance regulator, also doing that, and you are saying in mutual fund also doing the same thing. So whether it is banking, whether it is mutual fund, whether it is insurance, inclusion is the key. This gentleman, please, quickly sir. Just introduce yourself and brief question.
Ramesh Bhojwani from Mehta and Vakil.
I think your mic is not working. Microphone,
Yeah, Ramesh Bhojwani from Mehta and Vakil. First and foremost, many thanks to BCCI for organizing this financial conclave and inclusively covering all the aspects of the financial markets. The question is, our capital markets are going only one-way street, which is up, without a correction. There is an alert or there is a warning that markets which don't correct, they head for a crash. I would like to have your opinion and the panel.
Thanks. Dheeraj?
Thank you.
Thank you for asking this question. I think this is a big bone of contention at this stage. Are the valuations stretched? And particularly since the COVID times, we have seen one-way rally in the market and no significant correction. I think it's largely attributed to the macro environment in India and how we've seen unprecedented liquidity in the entire world, including the India. Now we are seeing a significant participation coming in from the retail investors, though we are seeing lesser participation coming in from the FPIs. So it's got to do with the liquidity in the market. The capital market's inherent nature is not to be a linear. The corrections will happen in the market over a period of time in the pockets, but I don't see the valuations at the broad, at least at the large cap level, there is any euphoric valuations at this moment. Valuations are reasonable. We are always been having a historical valuation of 20 multiples of the at a Nifty level. We are at 22 odd multiples at this stage. So little bit stretched, but not euphoric is my answer. Yes, there is some froth in the SME IPO. There are some pockets that are overvalued. I think it's only the DNA of the market that we will witness some correction over a period of time.
Thanks, Dheeraj. Yes, the gentleman wanted to ask, right? Yeah, please. Can you get the microphone? And then we'll come back.
Sir, my name is Piyush Shah. Question for Mr. Venkat. It is a good thing that you have digitalized the process of KYC and ease of doing business, but there is a further scope or room. If you can coordinate with various other financial people who are also asking for KYC, you may do centralized KYC like banking arms, DMAT and all these things. So it will be a very good suggestion if you can pull it out at one central level at being a CKYC in true manner. And further to that, one more thing I would like to add. If you can do ease of doing in other things which are having physical documents as of now, like maiden name to married name, minor to major, and deceased person's deletion, all this process, if you can smooth it at one go at one particular place or so.
Thank you.
Like KYC. Thanks
thank
a lot.
you. Venkat, he's saying that ease of doing transactions across different financial instruments. I mean, that's what you meant, that once you have KYC with a bank, it can be automatically with mutual fund. That's the kind of stuff you are saying about this.
A quick response from my side. I think we have come in a long way in terms of doing digitization and also making onboarding journey for various products digital. Today, if you look at, you can open any bank account through digital journey, you can open DMAT account through digital journey, you can do KYC in the mutual fund through digital journey. We've come a long way. Some more segments like minor, HUFs, corporate accounts, and for non-resident Indians, I think the work is in progress. Very soon you will see that ease of doing business there as well, and more digital journeys will come. I think we should take a pride in how we've adopted the technology on a payment space as well as on onboarding space in the entire BFSI space.
Thanks, Dheeraj. Yeah, you want to add anything?
Supplement
Yeah,
what
please,
Dheeraj
please.
mentioned. Like in case of mutual funds industry, what we have done, what I explained earlier, if you are validating your KYC with one AMC, you can do the transactions with any of the 44 AMCs, whichever product you want. That is the first ease of doing business that we did. If you are registered with one AMC, that means where your KYC documents are not validated but registered, then you can do only with that AMC. So that we made it very, very easy for all these mutual fund industry. But spreading across all financial institutions, that means being banks or insurance, that is what Honorable Finance Minister did mention, saying that we would like to have a common KYC, like the one we talked about, CKYC, which we are talking about our own KRAs, which are doing this particular job. Bringing them all together, that's a work in progress. I'm sure that will also happen in very short.
Thank you. Yes. Yeah, this is the last one. Yeah, please, quickly, very
Yeah, this is Ramesh Singh Rajput from RX Business Risk Management Consulting. I think sir has drawn very good parallels from Mahabharata. I think we should appreciate the foresight or the hindsight of Dronacharya, because of which Arjun could realize and Karan could realize his potential, and that put to use, and that could balance the Mahabharata, an interesting watch that all the stakeholders could have.
No, what's your question? Is there any question there?
No, that's an observation.
That's okay, fine. So thank you. Yeah, that's it.
I'll just like to add something here. I think whether it's banks or NBFCs or MFIs, the opportunity in India in terms of penetration is so large that all the entities will coexist and continue to do their job. I think there are merits in investing in all these spaces and leveraging technology.
Thank you. Thanks, Dheeraj. So let's go back to Karna, or he said Duryodhana, I don't know. So anyway, tell us about this, talking about the inclusive growth and the role of NBFCs here. I'm not getting into all the debate, what is your claim is exerted or not. But in particular, the MFI segment, if everybody says, particularly the investors and we the observers know, it's always cyclical. Every 4 or 5 years there is some problem or other. Like right now we are talking about, so during COVID it was a big problem, and then when you started talking about everything is fine, we also spoke about like there multiple things happened. This it started with demonetization, and before that, immediately after that GST, and then COVID. Everything is very sterilized the entire industry, lot of hygiene factors and all. But again, we are seeing that those institutions who are largely into microfinance are in trouble. People are not paying back and all. And the reasons are different. Sometimes it's flood, sometimes it's drought, sometimes it's political issues, sometimes people just don't want to pay and all. So how do you actually ensure the inclusive growth?
Yeah. So
because that I'm sure it's very disheartening for the entities like NBFCs and particularly the MFI NBFCs.
Yes. So while I'm not an expert on MFI as a sector, we are largely an MSME lender, but I can give you one, especially for MFI sector, which is the flag bearer for inclusiveness in India. MFI sector, it has been more or less established that every 3 or 4 years, there is something or other, an event happens because, MFIs suffer. Historically, those events have not been credit-related events. Those events were act of God or, sometimes political or, regulatory, not regulatory, but mostly political action. Flood, COVID, demonetization, Andhra crisis. For the first time, we are seeing excessive lending to, a customer who cannot afford a certain amount of loan, and that is ballooning the credit parameter to get here. So, which is a very, disturbing sign. Now, if you go philosophically why it has been happening, it is a matter of greed. All the MFI, lending, is to some extent is a fiduciary business. For lending entrepreneurs and professionals and people who run that business, because they, it is a function of equity plus debt. Equity chase price, price chase profitability. There is an excessive capital which has come from private equity and public market investors, which means that you have to demonstrate growth. And when RBI loosened up the regulation, a person who could afford only 50,000 rupees, 5 more loans have been given, and he's taking one loan from one person and another loan from other person and rotating that. So there is some, kind of stress has happened. It is riskier, not, I think so the cycle would turn, balance sheet would correct, it would come to normalization. But to your point, Tamal, if lenders are not conscious and if they create a bad name for a particular sector, it finally hurt the inclusiveness, because then new people won't be afraid to come into that sector. So I think so this is upon us that whenever we grow, we balance the demand from our equity investors and we grow in a calibrated manner. And if you try to do disproportionate growth, not remembering the fundamentals of credit and lending, then this risk could happen. And there are offshoots of happening. I think so now we are seeing the MFI industry is now traversing towards MSME. We say MSME is a massive offshoot. What you have seen in consumer financing, the personal loan, is this decade you will see in MSME, because the bottom line economy of tier 2, tier 3 towns around small business is becoming far more resilient, and that's where the credit would go.
Thanks, Sachin. You are brutally frank. Actually, you are to be blamed yourselves, right? It's the entities, the NBFCs or the MFI NBFCs. They are encouraging people to be over leveraged. So they need to be blamed. And incidentally, Reserve Bank of India actually freed the interest rate in March 2022. But as we speak, nobody has cut the interest rates. They actually have raised. So the very fact of freeing up the market actually is not worked to the benefit of the customers. That's one thing. So from there to Madhav, coming back again, you spoke about the good time now and all. So, but what is the way forward? Because everybody, I didn't want to repeat the same thing. India is the 4th largest economy, 5 trillion, 20 trillion, and 2047 and all. Out of all these jargons, but simply talking. What's the way forward? Is you are seeing that you spoke about twin balance sheets. You spoke about the structural shifts in balance sheets, more retail, not more retail in the relative term, more retail incrementally and all. So what is the way forward? Again, the larger theme for this conference is the growth and inclusive growth. In that thing, what would be the kind of role the banking sector is expected to play, or you think what's the way forward?
So Tamal, as a thumb rule, what we notice is that the banking credit grows by around 2 to 2.5 times of the GDP growth. So from that perspective, as long as the GDP growth is healthy, and that's what we're expecting, 7+, we would have a good banking credit growth also. But personally speaking, I think the worrying aspect is whether the liability growth and the deposit growth is taking place at the same levels. And my good friend Venkat sitting here, I think they have come out with a tagline which actually hurts us sometimes. The perception is that at least it hurts
Mutual
us.
fund
sahi hai.
So the bank depositors should need to come out with a slogan.
We are maybe coming out with some tagline, banking bhi sahi hai. That's on a lighter vein, of course. My personal take is that we need to probably go down the route where we are looking at, what Sachin said about MFIs going and lending to those people. Probably there's a greater opportunity for the banks to see if there are liability possibilities at the bottom end of the pyramid too. So where I come from is, I think the banking sector, what they learned from a marketing perspective was from the car industry. You have the cars for different segments. Possibly now the banking industry needs to learn from a telecom industry where instead of segmentation, we need to go for personalization. And again, we miss out the huge, the mass of people, 1.4 billion. I think there's a great opportunity for banks to be sort of more innovative there. And a bit of governmental support and regulatory support can also help banks sort of, make the deposits more attractive. That's definitely a thing. The other aspect which is something which we all need to sort of focus on would be the climate change and the ESG. Climate change is a thing which we need to be worried about. Of course, the government and the regulators are doing their bit. But when we speak down the line, the larger corporates are fully aware of it, and they have, working on the climate risk aspects. But when we talk about the mid-tier SME and maybe the individuals down, we don't see that much of appreciation for climate change there. So I think that's something which the banking sector will have to focus on. and sort of that would be driving the years to come. So that's something which would be an outlook from my side.
Madhav, I'll just give you one more small thing. I will take it forward because SBI chairman is here. Let him also hear, because this is the last round for us. Tell us, you are talking about the issues when the biggest problem at this point of time. You are saying they are raising deposits. That's what you said. If I am saying in my own word, but that's what you meant and all. And you spoke about how to get into the retailization, the larger retailization of deposits and all. It's something which Syndicate Bank tried in the last century, through the pygmy deposits and all. But in these days of technology and all, I mean, you can't afford to get into a collection mode that will push up your cost terribly, hugely, right? And typically for liabilities, you cannot use technology. Nobody would, because I need to trust you to put your money, to keep money with you. That through technology does not happen. I can take money from you through technology, but when I give money to you, I'm not very sure how many of us will be very comfortable. And these days, particularly when this frauds and phishing, etc., happening and all. So is there any concrete way? You said the mutual fund sahi hai, like you need to create a slogan, banking also, deposit bhi sahi hai. So actually you are telling me, but first put in mutual fund, then banks. You are saying no, bank deposit bhi sahi hai. No, you are not saying that. But you put the slogan at bank deposit bhi sahi hai, which means after mutual fund it should come. So galat hai, you cannot have that. Some innovative signal, slogan you need to come. You need to look for. But on a more serious note, just 2 minutes, what can be done actually?
Well, I have a slightly different view on technology. Technology can definitely be used. We have seen banks internationally. One of the banks which I used to work for, they had probably 60 plus branches in the country where they used to operate. And today they have probably 5 branches. And they have a neo-banking solution which is very much similar to what State Bank of India has in terms of YONO, which probably has the number of clients they acquire would be probably 10 times what a traditional branch would do. So the I think aspect which everybody spoke here about is about trust. I think people still believe in banks and the trust. My personal take, again, I think looking at examples right from history, we had a concept called wingspanbank.com. I don't know how many people are aware. It was a pure internet play bank in early 2000 during the dot-com bubble. That failed. And one of the things when people asked and did an analysis, it failed because there was no physical or the brick and mortar was not there. So possibly, I think going forward model would be the banks would need to have partners in places where they can't reach, and that some of the banks have already done that. But leverage on technology and personalization. When I'm talking of personalization, I think there are pools of liquidity which are available. We have to understand the person's requirements. There could be people saving in for education, there could be people saving in for marriage, there could be people saving in for festivals. So if banks come out with solutions which tackles into these pools, possibly we'll have to work out something different. And that's why I think the whole concept of segmentation has to be different. It has to be more on personalization.
Yeah, thanks, Madhav. But as we speak, the currency in circulation, which is the people with money, money with people actually is going up and up and up. I mean, we know personally that a lot of people actually keep money. It's not black money, but they don't want to keep it in the bank. They keep it there and then they spend for anything because those salaried people, the GST, they don't want to pay because there is no way they can get back the money. So whenever there's a interior decoration or so many things are happening on, they just use the cash and keep the cash at home. So there are issues to be addressed, and you are talking about lesser number of branches. As you speak, every bank is talking about opening up more and more branches as you speak. The large banks, private banks, public banks, everybody else. Dheeraj, you spoke about, we have about 10 minutes. Satish sir, we are running late, so you just bear with us. Not more than 10 minutes. So you said that markets is not overpriced, there is no irrational exuberance, it's here to stay, etc. But just tell us, not any specific stock, nothing, but some kind of advice, suggestions and all, if you want to, for the retail investors.
I think before I talk about the markets, I'll talk about the trust a little bit. I think regulators and overall ecosystem has done great job in terms of creating confidence among the investors. If you look at the capital market ecosystem today, if you buy and sell, you are dead sure that tomorrow you're going to get money in your bank account or you're going to get shares in your demat account. That confidence has also helped the increasing the participation in the capital market. And I agree with Madhav to that extent that banks can be a little bit more innovative in technology and leverage technology to increase the participation from the retail investor. Every nook and cranny of the country can be targeted through the technology, and we can get more and more depositors, more and more liabilities also in the system. Coming back to the capital market, I believe that we are well poised and we are seeing good equity participation. I call this as an equitization of the savings. I know many of you have heard about the term called financialization of savings, and that's something we have been witnessing in last 15-20 years, where people, our investors' interest have moved from a traditional physical assets like gold, commodities, real estate to the financial assets. Now within the financial asset, we have seen in last 4 or 5 years a tectonic shift in the equity as an asset class. And there are multiple reasons why people looked at equity as an asset class. One is that the real returns in the debt instruments, particularly fixed deposits, were abysmally low. Sometime it was, if you really take the retail inflation, consumer inflation, real inflation, they were negative also. So, and India is a young country with just about median age of 28. People have high aspirations. We are still a very low income country, less than $3,000 per capita. So obviously people are looking forward for a higher growth, and aspirations are high. That aspiration has dramatically changed the risk appetite, which wasn't there earlier. So now our younger investors are looking forward for higher risk. They are ready to take the risk, higher risk, and are looking forward for a higher returns. That's where we are seeing the more and more participation. So it's more structural, not, I don't see it's euphoric.
Thanks, Dheeraj. You re-emphasized again, and this equitization of savings, it's something you coined or you picked up somewhere? Just now here, or somewhere else you spoke about it?
No, I have written few articles on the same also.
Sorry, I am not aware. It's a nice, wonderful term. So, Venkat sir, last word is yours. I mean, for a couple of minutes as you speak, right? Equitization of savings. You spoke about how the AUM is going up and up and up, and how AUM as a percentage of GDP also going up, but still much more to area to road to cover. And also in terms of bank deposits, you were saying is percentage which was now is about 40%, right? 33% of bank deposits and all. So tell me, what's the way forward? Again, the overarching theme is this, the India growth story and inclusive growth. From that point of view, what's the role of mutual funds and the way forward?
So I'll put it in 3 parts. I'll make it in 3 parts. One, of course, one of the participants was talking about the valuation problem. So let me first address that. While people did speak about the fraud in the small and mid cap, there are good guardrails. The one that keeps me awake, being the chief executive of the AMFI, is that we are growing at a very, very faster pace, but we need to have a proper guardrails, because we are holding it in a fiduciary capacity of the money of the people. So what guardrails do we have? There, one, of course, this is the best in the world, trust me, giving a fact sheet every month where we are investing. 2, we conduct stress tests. We come out with the results. In the case of small and mid cap, we are coming out with monthly declarations, which tells about what is the time that we're going to liquidate this particular stock, how much time, what is the concentration of this particular stock, what is the volatility, etc., etc. So all these things, there are a lot of controls that are being put in place in order to ensure that the money that we are collecting from the people is safe. But there are so much we can do as well, and then you would have seen about institutional mechanism that is being brought in. But what has happened is when I started off my own career, we used to be reactive risk management. It moved to proactive, and today we are looking at a predictive risk management. That's something that we want to keep the trust of the people. The second important thing, I know Madhav was talking about creating deposits and then innovation in deposits. One of the successes, being a banker myself, I'm looking at why the success in mutual fund industry is. It has got investments, different, diversified. You have a target to for your children education, you have target for marriage, your target for traveling, you have a target for the retirement, you have different funds for that. There is a proper segmentation. You are a high risk taker, you are an aggressive risk taker, you are a moderate risk taker. Again, there are different types of products that are available. So that makes it different in respect when compared to the banking deposits. Maybe you can think of introducing that in these banking deposits as well. The last thing that we are looking at, how do I increase, like as we speak now, we are at the 18% of the total GDP, and then we are about 33% of the total deposits. How do we look at increasing it? There are one product innovation that we are trying to do. Two things that I'm doing. One, for the sachetization that you're talking about. We are coming out with a mini SIP. Very shortly, we're going to declare that, which will be around 250 rupees minimum SIP that we're collecting. And SIP is a phenomenal success. 23,000 crores is what we are collecting every month, 2 lakh crores per annum. So that's a phenomenal success. So we are trying to take it to the village, across the bottom of the pyramid, so that people can invest there. Second thing is, we are also coming out with a specialized product for the top end customers, where, because those are the monies which are going into maybe riskier assets, but they're not understanding that. So we are coming out with a product for people who have more than 10 lakhs. So that, for that, in very shortly, we're going to come out with a product. We're coming out with the innovations in the product, digitalization, reaching out to the people across the country is something that we're looking at in order to improve the financialization of the country. But last but not the least, I think Mr. Roy and they did say that let's come out with certain suggestions. One point that I'm looking at is every year, in fact this particular year, there was 3.6 lakh crores was the total money that has come into the equities market, be it in the form of mutual funds, be it in the form of other DIs or even FIs. But the new paper that has been issued is 2 lakh crores. That means 1,60,000 crores has gone into the increase in the value of the other assets, which we are talking about creating maybe some valuation concerns and all. One idea that comes is, of course, the other day we were talking to SEBI, and SEBI did say that there is a pipeline of almost around 400,000 crores. And of course, the good results of the company is also improving the valuations. But I would request, I think Mr. Shetty is here and PwC also there. It's a good time for the government to dilute some of the shares and bring in more paper into the market, so that the fraud that you're talking about, if at all it is there, can be controlled, and the capital formation, capital accretion can take place. So that's
thanks Venkat.
One thing for sure, we are looking to move towards 35% of the GDP, which will be almost around more than 130,000 crores.
So you are saying on the supply side to address the structural issue in the market. So thank you. Government should consider again quickly to get into the market with some of the PSU divestment, that's what you're saying. So thanks. It's coming to an end. We are running late, so I don't want to delay. Mr. Shetty is here. We can't afford to make him sit just in the audience. He has to come up. So what's the key takeaways? Yes, everybody agrees that the growth story, the growth momentum will continue, and indeed this is an inclusive growth, and the pillars are innovation, coordination among different entities and different segments of the market. These are the two things, and of course technology. And Dheeraj says market is not overheated. It's absolutely fine. It's not. There will be ups and downs, but there is nothing to be worried about. It's good to hear that. Venkat says that there are enough guardrails, which AMFI has done. He is also talking about the pygmy SIPs, like the syndicate bank we are talking about, like collecting deposits, 250 rupees of SIPs and all. That's the mutual fund. And both Sachin and Madhav are talking about the NBFC and banking sector, that things are good and there are structural issues like NBFCs encouraging some of them, their borrowers, the customers are being over leveraged. They have to blame themselves, and they must learn the lessons from the failures and what's happening, and move ahead. And banking sector, what Madhav said is this: yes, good time is here for stay, but banks need to be innovative when it comes to collecting deposits on the liability sides. So you have heard the stories of Karan Arjun and Yudhishthir Duryodhan, but everybody agrees that Amrit Kal is here. So give them a big hand, and thank you for listening to us.
Thank you, sir. We have a very pleasant task to perform. I would request Mr. Basu if you may kindly come up to the stage, sir, and do the honor on behalf of us. To Mr. Dheeraj Delhi. To Mr. Madhav Nair. Mr. Venkat Chalasani. And may we request our guest of honor, Shetty sir, to kindly come up to the stage, sir, so that we can have a group photo along together. If you may kindly do that honor, sir. I'd also request Aarti and Ron to kindly come up to the stage, and Sanjeev, if you may kindly have a photo together. Sanjeev. Sandeep, I was requesting you to come. Thank you, sir. Thank you, everyone. We'll just immediately start the next session. Please stay tuned with us. We are just starting the session with Mr. C.S. Sethi to kindly come up to the stage, sir. I would request moderator Mr. Tamal Bandyopadhyay to kindly come up to the stage, sir. We are just starting our session. If you may kindly join us, sir. We are honored that you have made time for us. Thank you. So, we are starting the fireside chat session with the Chairman of State Bank of India. Tamal sir is going to moderate the session. And the theme of the session is Indian banking system partnering growth towards third largest economy. Over to Mr. Bandyopadhyay.
Just wait till this. Hi, once again, good morning, and I promise this is you won't see me again, so just bear with me for next 20 minutes. So these are welcome. And again, this growth story to how India can become what's the exact thing is this Indian banking system partnering growth towards third largest economy. So before that, let's talk about how does it feel. You are less than a month, you moved into the corner room. So how does it feel to be the boss of India's largest? It's about 1/5 of the banking system, and the only bank, Indian bank, among the top 50 in the world in terms of assets. And even the market cap also you're rocking. So how does it feel to be the boss there? Tell me.
First of all, thanks to BCC&I for inviting me to be here and also giving an opportunity to talk to Tamalda. It's always pleasure to talk to him. To answer your question, Tamalda, I think it's a great honor bestowed on me. In fact, I felt honored when I joined the board of directors of SBI 4 years ago. And being chairman of SBI is definitely a great honor as well as a great responsibility. As you said, we not only cover 1/5 of the banking system, we pretty much cover every Indian family. We say that we are banker to every Indian. I would like to say that banker to every Indian family. So that way I think is a greater responsibility on me.
I'll just have one more question about SBI, then we'll talk about the larger banking system. Okay. It's a phenomenal run on the stock market, but I'm not getting into, I'm not asking you how you look forward, etc. Not that. It's based on the performance. And if I'm not mistaken, I think your research paper only said that the SBI's profits in 3 years between FY 2022 and 2024, combined profit of the past 3 years is higher than the historically whatever SBI has posted as profit between 1955 and 2021. So 45 and 21, 66 years profit is less than what SBI had done in past 3 years. Now tell us, is it like a dream, and will the dream run continue?
I'll answer the second part first. The dream run will continue, I can assure you that. I will also come to why we are confident that the dream run will continue. I think the way the numbers are put up is a fabulous way of representing how SBI reimagined, reinvented, and stayed relevant to the changing conditions, and took advantage of the changing market conditions and ensured that the balance sheet, which has been strengthened over the years, has been leveraged. I think that's the biggest point which these numbers indicate. But in terms of the dream run, Tamalda, I would like to mention your favorite quote that any SBI chairman, the standard deviation is only 10%, right? So I think even that 10% is very significant for a mammoth organization like SBI. I hope I will be lucky to make this 10%, probably 10.75%, with a positive sign in front of the 10.75%. So in terms of the potential of this organization is huge. I think we all believe in SBI that we have not fully leveraged the potential of this, the reach, the formidable reach this organization has, the formidable trust this organization has, and the formidable workforce, which is a qualitative workforce what SBI has, and our customer centricity gives me confidence that this is not one-off. I think the dream run will continue. And again, I would like to add that it's just to be in tune with the theme, what you have for the day, that the story of India is the story of SBI. SBI being a proxy to the Indian economy, and the way Indian economy is poised for growth, I think SBI also will flourish.
Absolutely, and SBI is in safe hand, I'm sure, because we have been watching your work in the past so many years and all. And you also know how to ride the animal, because it's not something you have been thrown into, the race. You know the animal, you can feel the animal and all. And luck only favors the brave, and the person who have the skill and expertise. Stupid guys don't get into luck and other things and all. So you have all the ingredients to be lucky also.
Thank you.
So tell us now, coming to some of the structural shifts that the Indian banking has been facing at this point of time. And it's very critical, particularly a country like India, still a developing country and all. The economy is actually, banking sector is a proxy for the economy. So unlike the developed markets where you raise money from the markets and all, here banking is the sole source for everything that happens and all. And we continue to talk about the credit growth is 2.5 times or 3 times of real GDP growth, not the nominal GDP. And if that happens, if the GDP is 7%, then we go to about 15 and 20% growth. That's the way forward. And that will make the in India the third largest economy in due course. I'm not getting into when and what and all. But tell us the structural changes. One is the deposits. Now, Reserve Bank of India have been repeatedly talking about, even finance ministers have been talking about, you need to find newer ways to get deposits because the credit deposit ratio is going up and up. Some of the banks are 100% plus, I'm not naming. Yours is not the case. But there are quite a few banks and all, and RBI is really concerned. And so whether it's Finance Ministry or Reserve Bank of India and bankers themselves, they say the biggest challenge at this point of time, earlier it was the bad loans, the credit cost and all, now to raise deposit to keep pace with the credit growth. So tell me, how is the banking sector, again I'm not talking about SBI in particular, but on behalf of banking sector, tell me what is the way forward? How do you manage this? How do you face this challenge?
So, sometime back in 2020, when I was heading the retail operations of SBI, I started a slogan called ABCD of banking. And the D in ABCD stood for deposits. And while to be in arithmetic, in alphabetical order, ABCD was there, but it was also a kind of reflection of the times where the deposits were actually flowing into the banks. But today, the D also has to come to the front. I think we need to reverse the order maybe. But structurally, if you see, I was just looking at the numbers let's not look at 1 year or 2 years. I think the challenge has come when the credit growth had overtaken the deposit growth. It's not that deposits are not growing. If you see in absolute numbers, we looked at the deposits had a 58% growth in 5 years. And credit had 56% growth. What is the dichotomy or, the differential is in terms of the preemptions which are there on the deposits, whereas the credit growth in absolute terms, will be higher. As you mentioned, the banking industry is a proxy to the economy because Indian economy is essentially a banking-led economy. It has not been a market-led economy. For example, in our foreign operations, we have a balance sheet of $80 billion, out of which $60 billion come from the market borrowings, $20 billion from the deposits.
Absolutely.
So here, the issue would be that the continued credit growth, how it is going to be funded, whether it will be funded only by deposits, and if there is some household savings, which were essentially captured earlier by banking system, is also being captured by other financial services players, what role these financial services players have to play in the credit needs of the economy is something what we have to be mindful of. I think some of the future credit growth or credit funding also has to be done by some of the other new financial services players now.
Must come from the market. Which
obviously.
Is the development.
Market, when I say market, it's not only about the capital market, it is mutual funds, it is pension funds, insurance funds. I think they all have to come into the corporate financing.
And sir, Seti sir, not only the deposit growth is slower than the credit growth, even within the deposit you see that like your current account, now you find that the corporations have become much smarter. They don't keep every money, the entire bulk of money in the current account. Float money, you just don't get exact. Earlier the IPO, you look at the every IPO was a bonanza for banks. You keep money for so many days. Now, money even does not get out of the banking, wherever it is and all, and it comes back immediately and all. So, dividend distribution. So, the float money does not exist for you. Even the government does not keep money with you. Government keeps money with Reserve Bank of India. And as and when RBI feels that thing, so that's the money is out of the system. So there are multiple changes in the deposit structure.
You're right. I think everybody is looking at efficient cash management. In fact, the way you asked in the last panel, mutual fund SAHI has moved the markets towards that. And we have been talking about the efficient cash management for years among the corporates. And obviously they adopted the efficient cash management now. And also the government has also moved towards efficient cash management, which means that the float funds will not be available, but funds nevertheless will be available. And the effect of that is that the CASA, which has reached a very high level post-COVID, will go back to the pre-COVID level. I was just looking at our numbers again, which a proxy to Indian banking system, is the pre-COVID level CASA ratios were 40%, whereas it went up to 45% post-COVID. Obviously, it is going back to 40%. It may further go down if the efficient cash management, just-in-time cash management of the Government of India comes into picture. But my reading is that the lot of small businesses still would like to be formalized and get into the banking system. They may be keeping cash because they are not are not getting the services which the large corporates get. What we are now focusing is that even the smallest shop owner will have the facility of a cash pickup, so that the cash which is lying out of the banking system will be brought into the banking system. I think this is some of the small innovations which we need to look at.
Well, sir, let's shift from the left to right of the balance sheet on the deposit and on the credit side. Now, there are changes in the credit side also. We are talking about banking as banks as the proxy for economy for a country like India. But if you look at this thing, even State Bank of India, your exposure to corporations are going down and down, and retail customers are more and more. So what does it mean? For the economy, what does it mean? The corporate India does not need money. They have enough. They're sitting on piles of cash. They can invest on their own. They don't need to come to the banks. And it's the retail, they need the money, and that's how the way banking will move, and that's how the India growth story will unfold. How does it work?
It's a mix of everything what you said, Tamalda, in the sense that starting with the corporates, for instance, post-asset quality review, whatever shake-up had to happen in the corporate world had happened, and the corporates which have remained have strengthened their balance sheet. Today, when we talk about the private capital expenditure, our corporate credit is not growing to the extent what it has to grow. That is essentially the moment the capacity utilization started going up, what we have seen is the working capital utilization has gone up. Then the next stage is the brownfield expansion. Normally that is what happens in the capital expenditure in the brownfield. And that brownfield expansion is being undertaken by their own cash accruals, because the balance sheet is stronger. So since they are using their own cash, it is not getting reflected in the corporate credit. So, but we also have seen that the current pipeline, which the good news is that in the corporate side, there is a significant demand for the corporate credit. And we are, with the last quarter also, we had almost 15 to 16% corporate credit growth. But in the overall balance sheet or asset mix, the shift from the corporate to retail had happened. And this retail is also contributed not only by retail personal, it is also contributed pleasantly surprised in both in MSME and agriculture, which is a very positive development, that when we talk about 65% non-corporate book of SBI, a significant portion of growth is also coming from agriculture and MSME.
I was coming to that. I think your MSME and agriculture, both growth is about 20% in the past couple of years, right? 16%.
Yeah.
Both, which is never happened before, right? What does it say for India growth story?
So, it is not only about growth story. The credit needs of MSMEs were always there, except that some formalization towards the banking has happened, because today the availability of information on any MSME, because of the GST, because of the bureau data. Just to give an example, SBI today up to 5 crore rupees has moved towards cash flow based lending, which is data based lending. So which means that some of the MSMEs which were not willing to work with banks because banks were taking longer time to assess, now are willing to work with banks. So the the credit needs of MSMEs are, maybe banks are more confident to lend to MSMEs today because the data is available.
So the need has always been there,
and that
but
is,
now
the shift is
because
happening
of
towards the
formalization, you get to see that, and the credit bureau also capture the data, so you know who to give the money and who not to give.
Absolutely.
And now another part of this credit story is this. Tell me, do you see cracks in the book? Like you are now historic low, your net NPA is less than 1%, right? I don't know when was it last. I can't remember that. But now, in private, bankers do say that there are issues, particularly in the personal loan and retail loan segment. All cracks have been there. I mean, I'm not getting into all the technicalities, but the SMA-1, SMA-2 kind of stuff is there. It's the 30-day, 90-day, 60-day DPD. Like people have not been paying and all. Private banks, what they do is whenever the loan turn bad, particularly in the personal loan, they write off, because the earning is so high from that particular segment, you can afford to write off instantly. Public sector banks don't do that. RBI is expressing its concerns about that. RBI has raised the capital requirement, raising the risk weight and all. Do you see some problem coming? I'm not talking about SBI alone, for the banking industry from the segment, personal and retail segment.
I think what we have seen, because we are also large lenders to NBFCs and MFI space, where large-scale unsecured lending happens, we have seen that the small value loans are having problem. I think the ticket size of 50,000, 1 lakh rupees, and mostly those
individual loans, not MSME loans.
Not MSME. I think at this juncture, that is the reason why the risk weights have been increased on the unsecured lending, mostly to the personal segment. This was also because the large number of new-to-credit customers have entered the market. They were first-time borrowers. Obviously, the credit discipline is yet to set in them. One structural modification what RBI has done is, much of this unsecured lending happens based on the bureau data, right? And the new-to-credit customer who does not have credit history, somebody makes an attempt to lend to him, and even before his credit history is established, he is borrowing from multiple lenders. That is because the bureau data gets refreshed every 2 months. And 2 months is a long time for many of these people to borrow multiple. And that is what's impacting their ability to pay. Today, RBI has come out that within 15 days, the refresh has to happen, which means that the database lending will become much more robust. I think the increased risk weights and this structural change in terms of the bureau data being available at a more frequent intervals would definitely help in terms of moderating any slippages what we have.
But at this point, there are some issues there, right?
There is some issue on the small value loans, definitely. But I think it is not reached a proportion where we need to really worry.
Okay, thanks. Good to hear that. So we have about a couple of minutes more. So let me ask you a sort of omnibus question. Again, not from State Bank of India, but for the entire industry, because you are the industry leader. 20%, at least 20% of the banking industry is on your shoulder. So tell us sir, entire architecture of lending in India, now at this point of time, there are, I would not say concern, but there is a bit of there are multiple things are happening. The banks, the NBFCs, the loan apps, you are talking about the giving loans and all, there are loan apps and often they are a proxy for NBFCs and all. There are entities, which rent out their licenses because they are the front, and sort of things happen and all. So in this entire scenario, how do things unfold? Because there are fintechs, there are tech fins, there are big techs, and all of them are in the financial sector at this point of time, in multiple ways and all. And right from buy now, pay later, I want to buy a pizza, I can just get $1,000, $1,200 loan on the spot. So this is the kind of scenario now. I know people, they drink beer getting loans from loan apps. They do, I'm talking about the middle class people. I know the lower state of people, they do their daughter's birthday, again getting money, $5,000 on the spot, the loan apps, etc., etc. So this entire world of banks, non-banks, loan apps, fintech, techfin, etc., and the technology and the other side of it and all. We're talking about India hitting the, becoming the third largest economy and growth, and an entire thing happening on banking. Reserve Bank of India just recently allowed one SRO for the fintech segment and 2 more under consideration, etc. You don't have any SRO, you have IBA, but not an SRO, it's an industry association. NBFCs does not have any SRO. Mutual fund have, microfinance have 2. One is MFIN and Sadhan, but NBFCs per se do not have, and they are the largest. They have thousands and thousands and lakhs of them and all. So how do you see the entire financial system evolving over the next few years? Because now everybody talks about technology, everybody talks about how to use the faster, in a few seconds you get your loan, etc., etc. But there are pitfalls also. So how do you see the entire, and you have your UNO is a great success story. At some point, one of your predecessors spoke about you taking market, taking to the market. But now at least you're not talking about that, but you are talking about taking to overseas, right? And it's a phenomenal instrument. So the entire, how you see the entire financial sector, particularly the lending segment, is evolving over the next few years, and how that helps the India growth story.
India is a vast and diversified country. I think after China, if you really see, in fact, sometimes I feel China is more homogeneous than India. And India is extremely diversified in culture, in terms of people, languages, and the pursuits of economic activity, what we do is also extremely diversified, which means that this economy requires as many diversified players as possible. In fact, that board is a replication of what we need. If you see that board, it has got every element what is required for the Indian economy. The mobilization of savings by the banking system and deployment of these funds both by the banks and non-banking financial companies, and NBFCs and MFIs bring the reach and at a lower cost than what the mainstream banks have. And the fintechs bring the innovation, what, in the financial services, both in terms of the designing the product and the delivery, more importantly, the delivery. So the trick lies in that what kind of responsible behavior all these players will bring together. While understandably why the regulator, see, unlike you talked about banking not having SRO, I think banking is a highly regulated industry. We do not need an SRO. But in case of NBFCs, there is an SRO, FDIC, what is that?
FIDC. No, sir, it's not an SRO. It's not an SRO.
Maybe they are moving towards SRO. And apart from the self-regulation, I think the primary capital providers have a greater responsibility. If banks are mobilizing the funds, savings of households, the responsibility of lending to the NBFCs, MFIs, and their lending practices, and eventually the last mile which is being provided by the fintechs, I think the whole life cycle of the money movement has to be responsibly done primarily by the people who are mobilizing the savings. That is where the RBI is coming out saying that I'm not bothered about who's the front end, but if he is using your capital and if he is using your name, the responsibility is on you. I think if we understand that and we put the guardrails in place in terms of the ultimate consumer is getting the money which is made available by the primary lenders, I think that is something what is going to help. And I am a strong believer that we have to have all the financial players operate in India. And they all have to operate in a manner that we'll move towards more inclusivity, more efficiency, or more customer centricity. I think if these three elements are made fundamental to our financial ecosystem, we need not really worry about too many players being there, too much regulation being there. I think this is something what we need to adopt.
Thank you, Mr. Sethi. So actually we carried forward from the past discussion where you spoke about inclusion, growth, innovation, coordination. And here the leader of Indian banking system talking about one more term is using, the responsibility. So I think this is the vast world where inclusion, innovation, coordination, everything is going to happen, been happening, but everything has to be done with responsibility. That's the key to India growth story. That's the key to make the financial system sound and resilient, which already is, but to continue to be in this position, and the key to support the India growth. Because in a country like India, still developing country, unlike developed market here, banking sector is a proxy for economy. Right, sir? With that note, if you enjoyed, just give him a big hand, and thank you.
Thank you very much.
Thank you for taking time off on a holiday and coming. Thank you, sir.
I would request our President-designate, Mr. Arnab Basu, to kindly come up to the stage, sir.
He's always provocative. Thank you. Thank you.
We'll have a quick 5-6 minute break, and thereafter we will continue with the insurance session. Please stay tuned with us. I would request you to kindly take your seats, sir, please. I would request all the panelists to kindly come up to the stage, sir, please. I would request Mr. Parthanal Ghosh, Director and Chief Business Officer, HDFC Argo General Insurance, to kindly come up to the stage, sir. I'd request Ms. Aarti Bhushan Malik, Chief Technical Officer, Universal Sampur General Insurance, to kindly come up to the stage, sir. I'd request Mr. Sundar Krishnan, Chief Risk Officer, the Life Insurance Corporation of India, to kindly come up to the stage, sir. And I would request Mr. Manish Alag, Senior Executive Vice President, Head Tide Wealth Insurance Manager and Direct Marketing Channels, Kotak Mahindra Life, to kindly come up to the stage, sir. And we are honored that we have Mr. Amit Roy, Partner and Leader Insurance and Allied Business, PwC, with us. I'd request you to kindly join the session. I would request everyone to kindly take your seat, please. We are commencing the session right away. Thank you. Thank you. Over to Mr. Roy.
I think it's delightful to be here talking about insurance and on a very interesting topic heading that Bengal Chamber of Commerce and Industries have actually made. Insurance for the people, insurance by the people, and insurance of the people. Would be actually candid in saying that initially when I looked at the topic, I was not really sure what are we going to do about that. But then Arnab and I had a detailed chat on that, and I am so glad that we are talking about it. Insurance is all about people, and today as I was traveling towards the venue and I was caught up in a very bad traffic, and festival day and all of that. Mumbai roads full of people. I was just wondering, and this is where the topic comes in actually. I was wondering what all is happening on the roads of Mumbai, how much of that is insured, And people probably talk so much about the Indian economy growth almost every day. The market is booming, and there's so-called a essence of people missing out actions out of that. But all said and done, I think country is on a nice spot. We are doing well. And it's a young country, and I am extremely bullish and optimistic about what all we are going to see. And probably we should start the discussion in terms of what's happening to people with the booming economy. And people keep talking about 5, 7, 10 trillion economy and whatnot. And good about that, if we are talking about such a great economic growth for the country, what does it mean for insurance? And maybe Parthanil, I would like to start with you. On the side of massive development, massive projects, someone was telling me 31 new projects super projects are coming to India. What role insurance would be playing on the growth of the country?
Thank you, Amit, and thank you for this great introduction. Yes, I fully agree that the topic in English was absolutely English. But good thing that it is insurance, not so interesting topic in that sense, so you wanted to make it lightly and lively. Yeah. So the role of insurance in the growth of the economy is, I think, we have been stating it year after year. There are various data points to show that our economic loss over the years on any events, any catastrophic events, is far higher than that of the insurance loss. Even after so many years, of course, it has improved incrementally, but whenever we see massive destruction, whether due to flood or earthquake or any other these kind of events, the insurance loss doesn't cover the economic loss for a simple reason, those are not insured. We were speaking about Bombay, growing economy, 31 new projects. Of course, the projects will be insured. And there is no doubt because there is a lending at the back of it. The contractors, they will be taking those project insurance. But how much it will add to the growth of this segment, it is a question because in India, we are moving towards a soft market, very, very soft market, and we are struggling with it. But still, that particular business maybe is a 15%, 20% of the overall industry. On the other part, on the retail part, when we look at individual lives and motor in 2018, when the Supreme Court ordered for a 3 years long-term policies on third party for private car and 5 years for two-wheeler, one of the reason of doing it is that people do not insure at the time of renewal after 1 year, largely on the two-wheeler side. For the first 2-3 years, the 50% uninsured on the road of India has actually come down because you have a 5 years period for two-wheelers, and two-wheelers are the, in a manner, bigger culprit in underinsurance or uninsurance. That part actually, when it came to 2022 and 23, after those 5 years, Amit, they have not insured.
Wow.
So now we have once again come back to a situation where we are roughly estimating that 50% of the vehicles on the road of India are not insured. This 50% can be 25% in Mumbai and maybe 75% in the hinterlands. That is one. And secondly, I'll just end with another data point. I was looking at the last 10 years growth of number of lives covered under individual insurance, in health insurance.
Yeah.
The growth rate, and this includes the COVID times where lots of people bought some policy or other, it is only 6%. Whereas the premium growth, the CAGR, is 15%. It says that actually your number of lives are not growing. It's a young country, then also it is not growing. Premiums are growing faster for two reasons. One is the medical inflation and the second is the age inflation.
Right.
So, in a sense, it is very important, but I believe there are events that happens when people become very, very conscious. After COVID, it happened, and after 1 year, actually, number of individual lives insured has come down. It actually has actually grown. Yes, in 2022, it came down. 2023, it grown slightly in a very, very low single digit. So,
yeah, I mean, that's very interesting point that you made on that data, and thanks for reminding us that, especially when we are talking about insurance for all by 2047. And actually the growth and everything is looking very rosy, but the number of lives in terms of real coverage, is it really happening, is something that we'll touch upon. But before that, Arti, I wanted to come to you with products. And everyone's talking during our industry days, we used to complain that regulators do not allow us products, you know. And every time, you know, our bosses would ask for more business and we'll throw our hands up saying, where's the product? You know, give me product, I'll give you 500 crores. But I think that's flipped. And now you can do anything and everything. But still, people who are the good lives, who are the young lives, don't talk so much about insurance. And I see some of the innovative products are coming up with now that you can start a product and subsequently file it after finding some positive aspect on that or the. Do you think on the product side enough innovation is happening to tap these 5 to 7 trillion economy that we are talking about? And does product really play a role in catching new market segments, new customer segments? Gen Z, everybody talks about. Yeah?
So thanks for this question, Amit. I mean, I would like to thank BCC&I for putting up this conclave and having an inclusion in a right manner and touching upon insurance as a important aspect of financial growth of the country. In India, if you talk about the insurance and particularly general insurance is still a segment which is not very popular, I would say, in terms of Parthnil has just touched upon in the event of a NatCat, we see that there is very less population which is actually insured and then hence gets covered under the insurance policy and gets their claims. So it's still a product which has to be sold. So there is always I mean, I would call it as typical what we talk about is it will not happen to me syndrome.
Yeah.
So people still feel, why do I really need it? So they look at insurance as other investment products, specifically general insurance, and then they feel if I pay a premium, what am I going to get?
I should get a return.
Yeah, I should get a return.
Yeah.
And what if I don't claim, then my money is waste, right? So that kind of a mindset is still there. So it's a high time that insurance companies, instead of selling what they have, they should create something which appeals to people.
Yeah.
As you rightly said, there is a Gen Z segment of the population which is so tech savvy, which doesn't want to go in a traditional way, go to an agent, go to a broker, or they just want to go Google search, do a website search, see some comparisons, quickly buy it on the click of button.
Yeah.
So it's not all about making the products available, it's about how you sell also. So we spoke a lot since morning, we are hearing out the esteemed speakers talking about the digitization. So that is also one of the keys which will take up insurance market here in India. Now coming to the question of having insurance products, as you rightly said, there was I would say a leeway of the people to say that we are trying to file the product, it should get approved and then we will come up with the product. And by the time we all do that, there is always a lapse of time.
Yeah.
But the regulator in their real development form, what we see, has come up with so many flexibilities in the regulation which allows insurers to file the product as quickly as possible, and hence we are seeing now there are different kind of products, different sachet products, different over-the-counter product, a package product, bundled product, different kind of long-term products, which is what we are going to see.
Allow me to stop you there, and to both you and Partha's point in terms of actual insurance penetration. If you really feel that people are looking at return from product, even on a peer coverage and health insurance coverage, and you can play with innovations of the product. Why is that anyone's not thinking in terms of health insurance product with some return? If people want that, I mean, is it something which is stopping? I mean, a risk can be priced and a product structure can be created. I don't know how many of people sitting out here want a health insurance product with some return. If I am keeping my healthy life, how am I getting rewarded? And is it something where I am actually subsidizing, cost of insurance for others who are not that healthy?
So if you look at the current offerings on health insurance products, these are combined with the wellness benefits.
Absolutely.
Right? So it is not just that, you pay your traditional way, you pay your premium, you get cover if you are hospitalized, the bills are paid. It's not related to that, but insurance companies are actually promoting a person to live a healthy life, and hence there are various wellness benefits which are being added, that if you're having an active life and you're doing a gymming or exercising, you're keeping your BMIs below the level, all of these things results into discount in premium. These things are already available in the market.
Partha, any comment from you? Yeah.
So I will not get into that whether anyone loves to have a return. Of course, everyone would love to have a return. You do not have to ask that anyone to raise their hands. My question on this particular thing of penetration, especially on health insurance, what we have seen that over the years, the people who buy a health insurance and then don't renew in the second year and the third year, a part of that actually gets into some other insurance company, which we normally as portability. But we have checked that there is an issue that the people cannot afford. So just I will touch up that point and you may try to elaborate it, Amit, is on affordability. India on an affordability index, though you talk about the fifth largest, is low on the affordability part of it, one. Secondly, if you look at the medical inflation point of view, when you talk about a predictability or a return, you have to have the predictability on the cost as well. Health insurers today do not have a predictability of the cost. The cost which increased during COVID actually continued after COVID. And that part, as insurer, we have not been able to control it. Now, till such time you can control that part, your premiums will increase. So the affordability, on an affordability index, more and more people will be out of it. So there is that part as well.
I will come to you and Aarti both on this when we discuss technology and data. But before that, Manish, shifting gear, again, I think whether it is PNC, health or life, one thing is sure that it's a technical game, and somewhere you need someone who is called a distributor in any form. It could be a digital distribution, it could be a hybrid, it could be a pure person-to-person kind of a selling. And with this background of, good economic growth and all of that, and so much of drive, something which is missing is still, creating that aura about insurance selling is a noble profession. So do you see some development around that, or do you think that something is missing which could actually give a lot of employment generation to a country like ours if people, come towards the side of the distribution and some better images can be created out of that? Because if you are talking about fifth largest market in making on insurance, we'll definitely need a lot of more qualified people, skilled people, not just on distribution, operations, technology, actuarial and all of that. Is that story, somehow building up? Your thoughts on that?
Yeah, thanks Amit for asking that question. Very interesting and I would say deep question. Yeah, as mutual fund markets, insurance sahi hai, so mutual fund sahi hai, I would say insurance zaruri hai.
True.
Right? Because it's like food, clothing, shelter and life insurance.
Yeah.
Because what takes care of food, clothing, shelter is life insurance. So what is life insurance all about? It's nothing but largely protection of income. And when we are talking about growing economy, it will also play a significant role in protecting the economy. Because when you start at a grassroots level, when somebody, a breadwinner in the family, buys life insurance, it's being bought to protect the future of family. So when you protect one family, in a way, then you expand to a city level, so protecting city. And when your penetration increases, of course, you're protecting the country against all the risk which can emerge out of lack of income.
Absolutely.
So here, of course, distribution will play an extremely important role, and education is equally important. And as you mentioned earlier, younger generation is not very keen to take it up initially when they start working. Whereas we say the bedrock, the base of financial pyramid has to be life insurance. Here, education will play a very important role. So, what we have started doing in a small way, we have started a growth manager program, wherein we hire management graduates from institutes and we induct them as growth managers. And it's a 2-year program which is only on education, and they are kind of go through various profiles so that we are trying to build talent of journalists, not any experts.
Very interesting.
Then we also have a program wherein we call it management training words. There, on an average, we hire about 400 plus management trainees who participate in that program. And then we are also recruiting from graduate institutes as graduate trainees.
Wow.
So we are trying to do this keeping future in mind, because today, if the industry has to expand, if industry has to expand, education is extremely important. Everybody feels nothing will happen to me, something will happen to my neighbor, but nothing will happen to me. So that education, that understanding is important. For that, different distribution models are required. Traditional models, of course, important. Not that traditional agency models are not, especially in a large country like India, traditional insurance models like agency will continue. Okay. However, the method might change. It might become more of phygital. Right? So the sellers, whether you're selling through a bank, or you're distributing through agency, or you're distributing only through digital channel separately, that digital assistance is important. Because nowadays, the way things are in most of the industries and products, people research online and they buy offline.
Nothing bad about it.
Nothing bad about it.
It's hybrid, right? In a way, and probably the challenge to all of you is how do you hook the customer when that research is happening?
Absolutely.
And how do you ensure that experience actually plays a role in terms of upping the price, right?
Correct. So once somebody comes on your website or an app or a portal, then how do we engage? By way of consultative selling, a need-based selling. And products have actually evolved. I'm sure you have witnessed yourself in the last 20 years, what products are there today as compared to earlier. They have really evolved. And just to answer your question of getting young customers on board, in fact, we launched a product 2 months ago called Generation to Generation, wherein the father gets insured and he's insured till the age of 60. And after 60, without any underwriting, the same cover is passed on to the next generation.
Yeah,
so those kind of innovations have started now.
So Manish, you know that as a consulting firm, we keep doing a lot of research. And as a consultant, I consciously avoid quoting data or research or data point. It becomes so boring at times. But can't help mentioning something where I am trying to hint at. 48% of earning is getting still generated from farming, right? And which is not easy. It's sun and rain and so much of hard work and stuff like that. The research says less than 6% people think about earning. I am talking about think about earning. Forget insurance, even financial services, right? Which encompasses bank, this, that. Now you and I know that distribution plays a huge role and skill plays a huge role. Risk assessment plays a huge role. All of that. Why is that 48%, which is coming largely from hinterland, are not looking at insurance as a preferred profession? Probably, we should ponder over that. Sundar, any thoughts on that? Is that an opportunity? Or
I agree with Manish. Things are going to change.
Yeah.
Now, for instance, I work for LIC, and what LIC has decided that in 2 years' time, they would be paperless. It's a very tall task, the way they work and the way they are structured and the traditional bound. But they already hired a large system integrator, more than 400 crores, then one consultant, again, for a digital transformation, again 100 crores, and then one agency transformation person, again 100 crores. So 600 crores already spent. So that's the kind of money is being spent on digital transformation today. So, and if you look at the regulatory changes that are happening in terms of need, necessity, then customer signature or customer understanding of the product, and surrender being available in first year, health insurance again, you after 3 years you will have to cover even the existing diseases. So the kind of changes that we're going through is amazing. And so while I agree on sustainability, we are doing very badly. On risk coverage, we are doing badly. But the medical inflation is so bad that it forces you to think about health insurance today.
Yeah, that's what Parthenil also said.
I totally agree with that. And so things would change in 2 years' time drastically. And the regulation is forcing it, the infrastructure is forcing it, sustainability factors are forcing it. And I think I thank BCCI to organize such a good conclave, thinking on the changes. And these things would change in 2 years' time. At least I am bullish and positive. And so what would happen is, and of course education is key for this. I mean, a lot of time is being spent on educating staff about the changes, about what would happen, how do we adjust to the changes, how do we transition. Because from being paper-oriented to being paperless in 2 years is like huge change. And cyber risk increase added to all this. So,
you know, the point is what amazes me is that other day I was talking to someone who is attached to gaming industry. Okay. And nothing is right about it. On the contrary, if you talk about insurance, it's a very noble profession, right? You are, doctors give life before death, you are giving coverage in terms of any kind of uncertain event happening and stuff like that, whether it is PNC health and stuff like that. I am told that in India, last 5 years, gaming has become close to about 80,000 crores of, economy, right? Good or bad, that's the reality, and you have to accept the reality. Post 60 is the population, which is about 32% of the gaming janta. Now, if they are gambling so much and spending so much time in, playing all those games, why can't they be a part of, distribution, insurance, variable staff, health, PNC? There are plethoras of opportunities available. Are you seeing any traction? Is there something that you want the regulator to do in terms of developing awareness, or,
there is a perceptible
1 point each from all of you on that?
No, there is a perceptible change now. I mean, I've crossed 60, so I don't want to say that I've crossed it. And I would like to work, and I'm being guaranteed work for 5 more years. So there is a perceptible change now. And the aging population is adjusting to the change. And they are looking at avenues. And if no avenues available, I don't blame them. Gaming is available, they adapt that. I mean, this has happened in the West, it's going to happen here. Nothing is going to stop that.
What's your thought, Parthenil, on that? You think?
You said 2 things. One is on the hinterland and another is age. Yeah. I think Sundar answered the age.
Both the sides. See, so you think about the new people, young people creating job opportunities, earning opportunities, and also on the silver economy side, right?
So now that the thing that the rural India, the distribution, so regulator did something a year back, and they started talking about panchayat level distributor of a very, very simple product to include term, include a home and a personal accident, which is known as Bima Vistar.
Yeah.
And this distribution that they said preferably women is called Bima Vahaks. The how to license them, this thing has just come now, and that's the reason it has not happened. But I can tell you, we are the lead insurers in Tamil Nadu and Puducherry from the general and health insurance point of view. We went to the panchayat level, we went to the pradhans, and in the last 3 months, we actually could gather 3,000 willing applications from women, from absolutely rural people who had nothing to do with insurance or financial services. So
I don't know where is Orno. This is really for the people, of the people, by the people kind of a thing.
So that's
amazing.
So that is happening. Of course, you have to give some time, because whether the product is right, whether the pricing is right, you have to really go and test in the market. But that movement is started. So if it is happening with us, it is happening with other 31 general insurance companies and similar number of life insurance companies, and maybe in the next 2 to 3 years, you will see that the distribution of insurance, which is both physical and digital, because they will be selling this product on maybe on the smartphone or at the CSC centers or the kiosks. So this, I will say, it's a revolution. And when suddenly you will see that you have added 5 lakh or 10 lakh additional Bima Vahaks who are not your agents, and maybe we will be discussing here only in 2026 on that topic.
Aarti, any comment from you on that, in terms of employment generation, earning opportunities?
So just taking a thread from what Parthanil has already discussed, the Bima Vahak is the very unique kind of a concept. And these are the Bima Vahaks would be the females of the rural places. So it's a good and great combination of physical as well as a digital distribution, because we are trying to reach to the population which has never been insured or which have never even thought of insurance. So if we want to capture or reach to that kind of a population, there has to be someone who is from themselves, like between their groups or the communities, who can explain the need, who can explain the utilization of the product.
I have a point here to make, Aarti. What Parthanil said and you are also saying, do you think that those Bima Vahaks will make decent earning, and the point of sustainability, their sustainability in the system is also critical. Will they make money?
Surely they will make money. I mean, this is the alternate earning sources for them apart from the farming or the regular work which they are doing. Apart from that, they are going to bring the security to the large population out there. And once you are secured financially, it always takes you to the next level of the paradigm. So that's how it is going to happen.
Manish, any thoughts from you?
Sure. So are
we looking like 50 million agents coming to, POSPs, agents, everything put together, distribution, whatever you call it, Bima Vahak?
No, I would like to talk about two things here. One is employment opportunity in the industry, and second is the penetration. So when we talk of employment opportunity, we know currently there are more than 2.5 million agents in the industry, about 25 lakh plus agents are in the industry. And
talking about making it 10 times actually.
Sorry? Yeah, it'll become 10 times. And when you spoke of around 32% people who are into gaming are above the age of 60. So I was thinking in my mind, within our distribution, we have around 32% agents who are retired.
Wow. Yeah?
Yeah, we have 32% agents who are retired, another 32% are homemakers, and another 30-odd% they're small-time business owners, and then balance is about financial distributors and some other profile. So by design, we recruit such advisors. Because when you recruit somebody who's retired, let's say a lot of agents who have joined us, they are retired bankers. So they know how to talk about financial products, how to do need-based selling, and they already have so that, of course, when we talk of metros as market, so it's working very well in these markets. When we talk of smaller rural markets of hinterland, I think IRDA has taken a very good initiative wherein every insurance company has adopted a state. So it's still at a very nascent stage. For example, we have adopted Tamil Nadu, and now earlier there was a mandate to sell certain percentage of social and rural sector policies. Now that has changed, that every company also needs to adopt a panchayat level list and then increase penetration. So these initiatives have just started a few months ago, but I am sure in the long run, these steps are in the right direction, and it will also help penetration. And personally, I am really bullish. Industry has done a lot as far as employment is concerned, and it will continue to do so. Of course, we have to do it the right way.
Good to know that. Shifting gear, Parthanils, we have spoken about distributors, we spoke about customers, we spoke about enhancing the base of insurers. I keep talking to people who are intending to look at this large market. And one thing they always talk about is that unlike other markets, this is not a market that makes margin in insurance selling. So it's not a profitable venture, right? So that set of people, by the people, they play a large amount of role in terms of investing their hard-earned money, right? And so much has happened over technology, data, digital and all of that. But still I keep hearing from most of the CEOs, we don't make money. So if we don't make money, how will this industry grow? How will we insure people? And what are your thoughts in terms of making margins for the industry?
So I never felt that I'll be asked this question beyond some boardrooms.
You're a friend, I can take liberty.
So, yes, this is an issue.
Yeah.
But when you look at some of the top players, including some people who are not here for 20 years, they have started making money. And I'm talking about in general insurance and health. Yeah. So it is possible to make money. One of the reasons that most probably it is happening that we are a cost-conscious country. So it is not something that every year if you increase the health insurance premium, though we know that the medical inflation is 10 to 12%, then also the media, rightfully so, because they speak on the behalf of the consumers, the same affordability thing, they speak about that the cost has gone up. So that happens, and that will be there. At the same time, and you raised a very, very important point of digitalization, phygital, and improving distribution reach. At the same time, every organization, I think, have to look at their sweet spot. What is their sweet spot? Not all distribution channels you are going to grow at the same point of time. Lots of large investors we know want to do that. I'd not say investors, the insurers, the traditional insurers, they have a problem. They have a mindset issue that we have a ROE of anything between 15 to 16% in Europe, and why it is negative in India, why one company is giving a dividend of $1 billion in some country in Asia, and in India the same subsidiary is giving zero. This discussion will continue. But on long run, this industry, and there are a number of companies which shows that they have given decent return. You have to be patient, and most importantly, and this is one point I think I wanted to raise also, that the trust element of the Indian insurers in the mind of Indian consumers have to increase.
Great point. Yeah, great point. And maybe,
I just thought I'll add
Sundar, I also wanted to flip the question a little differently. When I am talking about people who are investing money, I am also talking about, I don't know how many people sitting out here invest money in stock market or mutual fund. How many of them? Very few. And how many of them have invested for insurance stocks?
Wow.
Oh, wow. I'm glad. I'm so happy. Big hands for those people, please. Who are doing something for the people. Come on. So the point,
I just come back
Sundar,
to the
to
same
insurance
question.
stocks, why that belief is not coming up. While you and I know that, and Parthanil said a very important point,
Yeah.
sooner or later they'll make huge money. And all the investors will be rewarded. So
I'll come back
comment
to
on
the
that.
same margin question. I think now the insurance industry is saddled with regulatory changes. Same as products, a way they operate. Having said that, there is a solid thrust on solvency, reserves, in terms of the kind of backing that insurance companies have, in terms of safetiness that they have. Between a bank, mutual fund and insurance company, which is more safe insurance company? It's all about safety. So, absolutely there is no problem on trust. The issue comes in margins. Yes, the margin, there is a problem because of regulatory thrust, because of the changes, because of the way you need to operate. But digitalization and the numbers, the sheer numbers would ensure that even the lower margins that you make, the numbers would drive that, the profitability up overall. If you see LIC, its profits are growing every year. So the numbers that you have ensures that the margins are good enough to drive the growth. And that's what would the change be. And the digitalization.
Yeah, I think that's a great point. I also want you to double click on the point that probably with more and more of the point that you made, more of disclosures, that it's a very well governed, like IFRS 17, it will give transparency. Somewhere I believe that probably the common people do not understand the way you all present your P&L. You know, so
every product now needs to be explained in a page, understood, signed off. Then only it can be sold from October 1. So, I mean, things are going to be simpler in that sense. If the understanding is the issue. It's not. It's theoretically simpler, but it's going to take time. Having said that, the understanding is better in the customer fold today.
Are they knowing your background on the PNC side, the margin profitability issue and large risk, and in terms of how much of digital is helping you to make the underwriting better? Is that a better story which is emerging now? And do you see that India as a market is becoming more honest?
Yeah, I mean, of course, when we talk about insurance, and particularly general insurance, first thing comes to our mind is motor insurance, then health insurance, and there is quite a large piece of PNC, that is property and casualty insurance, which is still being ignored, except the large corporates or the mid-sized corporates or the business houses. People are reluctant to buy insurance otherwise. So if you talk about everybody in this forum would have had car insurance. It's a compulsory thing. Everybody will have a health insurance because COVID has proven it again that that's very necessary. But if we talk about home insurance,
home is
still, I would say the people sitting in this room would not like it would be to my pleasure and to everyone's pleasure if everybody raises their hand who has a home insurance, right? So it's a basic thing. So
home is, you are talking about content, right? You are not talking about the structure.
Yeah, structures again people insure because they take bank loan and then bank insists that yes, you need to take an insurance, that kind of a thing. So when it comes to a large and
this home insurance point for you guys also.
Yeah. So when it comes to a large and a complex risk and the industries and the business houses, the data plays a very vital role.
Right.
As we see, banks, the CIBIL scores are something which is available at the click of the button. Pan India, everybody can, banks can access, check the authenticity of the records and work on it, right? So similar kind of efforts are there in the GI industry also. There is an arm of IRDA which is called as IAB, Insurance Information Bureau, who is taking efforts to collect information from all
Are you making profit on your fire, marine, or even, okay, let me touch upon the other one, which is crop. India is only 20% odd covered on the crop side, and I know most of the insurers are not really comfortable, and I can understand that feeling that land records are not digitized. Ultimately, I do not know what I am. So transparency is digital and data and technology. Everybody talks so much about digital and data, but ultimately that has to somehow either make it profitable or the cost of insurance should go down. So as a customer, I should be paying lesser money for my risk coverage, or, end of the day, it should be lesser hassle. So are you making money on that? That's my question. Do you see that much of transparency is getting created that you can price it right?
So yes, I mean, digital ways of doing business always creates a transparency, and that's where the thirst is. When we talk about the large population and when we talk about the remotest part of the countries and reach out there, there is also an element of a fraudulent things which are happening around. So data and analysis always helps you to curb the fraud also. So what we talk about is, you are talking about the profitability. Profitability should not be seen as one thing alone. It should be sustainably profitable.
Any comments? Parthanil.
No, you spoke about digitalization and you spoke about crop, I believe.
Yeah.
Huh? So I think
the margin part of the same question.
So there are two parts to it. The margin also in case of crop, you have to see that when you are bidding for that insurance, at what technical pricing you are doing, or are you looking for that insurance for something else to manage your balance sheet. As far as we are concerned at HDFC Ergo, you can see that over the last 12 years, we are one of the largest in the crop insurer. We always bid margin, always. And there has not been a single year we decided to go out. But on the other side, and this I do not know how many of us also know, the crop insurance is fully digitized. Even individual claims are uploaded on a crop insurance portal managed by the Government of India. And it is amazing to what level, at the farmer level it is digitized. So there is nothing that a paper comes and then you start looking into it.
Probably tell people about National Crop Insurance Portal also.
Right. That is what I'm saying. Second part is on the crop cutting part or the claims intimation part. So there are drones are being used. Of course, we are doing the crop cutting experiments. That is also happening. And the drones and the local weather stations have become very, very sophisticated today, where you can actually say that what is the pricing. And now the governments, individual state governments are also sensitized. They are a part of this entire program. And over the years, if you see, today if you see that the crop market is actually degrowing, it is not degrowing because your coverages are not increasing. It is because the government, what they have doing, that they are reducing this margin and making it in a kind of a loss corridor, so that no one will be making too much of a profit, no one will make too much of a loss. So the risk margin that you are saying are depleting, but it will be at a particular level. Because this is crop insurance, this is really for someone where the government doesn't want to give you too much of a
and this
margin.
is important because this is in the background of the stories about, you keep hearing Maharashtra farmers suicide and all of that. You keep listening about that, right?
Just to add what Patanil said, so even our company, Universal Sompo, has delivered, I mean, crop insurance has been the best in terms of the margins, right? And what I see is, how do you reach people and how do you look at the claims which are happening and how do you price the risk? There is the key.
True. Manish, before we hand it over to the audience, for one round of questions from their side, one very important thing on product, on life side, I still recall there was a time when people were super happy because unit-linked products were made available to people. Okay, right. One of the companies started, everyone else started following the suit. Right. At another point of time, all unit-linked seller people looked like Amrish Puri, the villain, not Amrish Puri the person, okay, and people wanted to actually chase them, kill them, do all sorts of things. The same people become super happy, and then there's a time that lot of variety in terms of pure protection product is getting talked about. Do you see that shift in the mind of the people? Ultimately, is it still product driven? Or really the need analysis or something is happening with this technology availability? Your thoughts on that?
Things are really changing, Amit. Slowly and gradually, but they are changing. Need-based selling has come to the forefront nowadays. That's the reason you look at various life insurers, they have come out with different products. Nowadays, within term, there are different variants. One is, if customer needs pure term, lower cost term, there is a simple pure term insurance product. Somebody wants return of premium, there will be return of premium products.
Yeah.
And then there are also products like Tulip, a combination of term and ULIP. So everything depends upon the customer's need and what customer wants. So nowadays, products are not designed based on what we want to sell. They are designed based on what's the market demand.
Absolutely.
And as I spoke about gen to get younger people on board. I mean, till 60, you cover the breadwinner. After that, you cover the next generation. So there are lot of innovation is happening. And companies have become more efficient, cost efficient as well. That's the reason. If you look at even the returns, what companies are giving today are way higher as compared to what it used to be. So it's an element of savings, risk, everything put together. It's a whole basket.
So Sundar, I see dramatically the complaint of people, the way it is monitored has drastically come down for the industry, and that's a good story, actually, to the point. So you are from the largest life insurance company, not just in India, but one of the largest in the world. So what are your observation? Are we really selling need-based now? Do you see a behavioral change in the mind of the agents? Because LIC is all about agency. Do you think data digital played a role, experience plays a role?
Definitely, and there is a lot of changes, and of course, regulatorily thrust also. And distributors are changing. Consumers are changing now. They're becoming smarter. If you see the product options, everything is available in a product. Combos are there. So all that is not seller determined, it's buyer determined. And so there is change. And definitely 2 years time, as I said, 2-3 years time, things would change in the market. It would be more and more market oriented. So I think when it comes to safety, liquidity, insurance is there. We want growth, aggression, you have mutual fund, and then you have the deposits in bank. I think as an individual, you need to invest in all the three. They serve different aspirations of people, and there is no doubt on this. The kind of medical inflation which is there, you just can't survive without health insurance. Same as goes with home insurance. There is no survival, and same it goes with life insurance. I mean, it's become it is a necessity. So, insurance jaruri hai is a good term.
Thanks, Sundar, and I think last about 45 minutes, thanks to the eminent panelists that we had, and hats off to their candid answers, and they allowed me to ask all the uncomfortable, not so planned questions. Can't thank you guys enough. Can't thank Arnav enough for creating this great topic of insurance for the people, by the people, of the people. I think this panel deserves a round of hands before we hand it over to the audience. Arnav, I don't know whether we have the time for questions now. Couple of questions, yeah. Yes, sir.
So my name is Deepak R. Khemani, and I'm a life member of the MDRT, so you all will understand where I'm coming from. Will we ever have a one product where I can get life insurance, I can get investment, I can get health insurance, everything at one place? Today I need to buy a life insurance policy from LIC of India, buy a health insurance policy from HDFC, buy a general insurance policy, car. Is that possible? I'm just throwing a thought. One. The second thought is, can we ever have a ULIP type of a structure in a health insurance policy? Because the way the premiums are going up, in the last 2 years, I've got at least 20 senior citizen clients who have had premiums of more than 1 lakh, and they have stopped their policies. 2 thoughts.
All eyes on Sundar.
So there is talk of already composite insurance. So I think it would come. There's no two doubts in that. Only question is when. It was expected this year. I don't know how bad, good, but definitely it will come. There's no doubt on that. And so it would serve all the needs. And LIC is supposed to be getting into health insurance. So I'm with you.
अच्छे दिन आएंगे.
Any other questions? So it's only a question of when.
The health, can it be combined with?
Yeah, of course, it would. It would. If Jio were to get into insurance, they have 7 crore customers. They would naturally offer all the 3 to their customers. So
we have a few Aladdins here, so jo mangna hai, aap mang lo, you will get it, yeah.
Hi, this is Ramesh Singh Rajput from RX Business Risk Management Consulting. I think this is 18th of September, and from 30th of September, a lot of things going to change in the insurance industry. I think we are at a unique junction where the regulator is trying to empower the customer, but not intensifying the seller or the person who is selling the things. I'll give you a point wherein the Bima Trinity that they have came up with, the product that will comprise of life insurance, health insurance, and the home insurance, that will one product.
Sorry, what is the question? I have to also be mindful of the time.
No, I'll just tell you what the question is. And they are coming up with a unique platform. Policy Bazaar was already there. Now we're coming up with Bima Sugam. So at one point of time, as sir knows, there was a time when everyone in one family was LIC agent. So there was no shortage of distributors. So now POSs are coming.
What is the question? Sorry, I have to manage the time.
Yeah, but I am concerned about the sustainability coming from here.
Don't worry. With all these great leaders, insurance is going to be sustainable for sure.
Yeah.
I would have loved to take more questions, but there are many other sessions for the day. Thank you so much. Thanks for being good audience. Thanks, panelists.
Thank you, sir. Thank you. Before we conclude the session, we have a very present task to perform. I would request Mr. Ranajay Basu, the chairperson of the committee, to kindly come up to the stage, sir, please. I would request my colleagues to kindly, to Mr. Parthanil Ghosh, to Mr. Sundar Krishnan, to Mr. Manish Alag, to Mr. Aarti Bhushan Malik, to Ms. Aarti Bhushan Malik, to Mr. Manish Alag, to Mr. Amit Roy. Please be seated. We will, due to the shortage of time, we'll be starting the next session immediately. Please don't go away. We are starting the next session immediately after this. Thank you. A group photo, sir. I would request Mr. Nitin Jain, Partner PwC, Mr. Amit Gupta, President and National Head Wholesale Business SBI Mutual Fund, and Mr. Sandeep Chavadia, Lead Passive Business HDFC Mutual Fund, to kindly come up to the stage, sir, please. Inside, meanwhile, I'll request you, Mr. Jain, to kindly commence the session. I'm ushering everyone inside. Thank you.
Thank you. Good afternoon, all. We have a very interesting session after the insurance. It's all about investment, and we are witnessing really exciting times. If you look at the overall capital markets, especially on the mutual fund industry, about 66 trillion. We have kind of seen the growth almost sixfold in last one decade, from 2014 to now. But if you look at the overall growth, the first 10 trillion, it took almost about 3 decades to come to that level. And now we are witnessing that unprecedented growth on the back of the right economic indicators, the investor education, and the larger retail participation. So obviously we see a lot of growth, and when you look at the market, which is kind of unidirectional for last couple of years. We have not been seeing going them anywhere towards a downward trajectory, because the fundamentals are correct. But we really don't know how long it will continue like that. And that's where we also see that, okay, there is this entire excitement about the magic of compounding in mutual funds, but we are also witnessing that, is there a kind of risk, and how do the customers really take on that? And I think that's where our topic is today, which will really throw light on a few of these things, and we'll touch upon mostly how do we see this entire compounding, how do we manage this entire risk, how do we really educate the end consumer or the customer, what could be retail, what could be institutional, and that's where I think let's dive into the session. So before we really go there, I would like to ask the same questions to both of you. How do you see this entire market and the way the returns are compounding? Amit, over to you.
So thank you, Nitin, for this question, and first of all, thank you BCCI for having us here. It's a very pertinent question in a market which is making a one-directional move, what we have seen in a post-COVID era. But this particular bull run notwithstanding, when you look at the longer run, when we speak about the last 2 decades of the whole market evolution, generally markets are always a slave of earnings. So if your economy is growing, say nominal economy is growing at say 11%, you look at the Nifty returns CAGR for the last 20 years have been 12%. Now, markets are never linear in movement. There have been periods where the large pullbacks were there. The pullback of say 2000, the tech era, the tech bust. Then we have the great financial crisis of 2008. Not to mention mini Lehman crisis in 2000, the demand of 2016, the NBFC crisis of 18, and then COVID. So these periods will keep on coming in the markets. What investor need to look at is the kind of appetite which he has for taking the intermittent volatility and the duration for which he is investing. Equity markets by very basic nature will remain volatile. In a short term, they are always being guided by greed, fear, expectations, supply and demand. But over a longer run, as I mentioned, it is the earnings which dictate the whole price movement. And when we look at the Indian economy for the last 20 years, on nominal terms, we have grown on an average of 10-11%. And the markets also have mirrored that trend by giving returns which is 12% CAGR. And then there are certain indexes, the small cap or the broader one, which have gone to 16, 17, 18%. What investors have to keep in mind whenever they are investing into equity is two things. First is the time horizon. Whenever any investor is putting money, they have to make sure that their investment horizon should be equivalent to the whole cycle which is there in equity market, and generally we see a 5-year kind of a cycle. So even if you are coming at the top of the bull market, you should not lose out. And second is the appetite, as I mentioned. So it is extremely important that whenever an investor is putting money, there has to be a proper risk assessment, and then there has to be a planning about the portfolio management, where there has to be a combination of both equity and debt and hybrids, rather than only speaking about equity markets.
Sandeep, what's your thoughts?
Thanks, Nitin. Thanks, BCCI, for inviting me here for this panel discussion. So, of course, everybody knows the capital markets in India are in that Amrit Kal phase, as one can say. And the Indian investor has come of age. The mutual fund investor has come of age. I know that we've been in this industry for so long. We've been advocating investment through SIP. There has been a long campaign by AMFI on mutual fund sahi hai. Maybe all these things have come together, and there has been unprecedented interest in the capital market. And fortunately, a lot of money is being channeled through mutual funds, where investors are oriented towards investing for the long term. I think once you decide to invest in equities, you are looking at, of course, better returns. You want to take care of inflation in the overall scheme of things. And if you tie that in with long-term orientation of investing, I think it's a great journey towards wealth creation. And we are seeing that unfold. And I must say that all the stakeholders, whether it's the regulators, the industry, the distribution community, everybody has contributed to this. And I think great days are still ahead for India, because economically we are one of the fastest growing large economies in the world. And in the current scenario, it seems that the next, we are at the cusp of increasing overall per capita GDP income. So we are still at $2,500. We can go to $4,500 in the next 5 to 7 years. And in economies and countries where this transition has happened, there has been a continuous boom in, the consumption and all the other parameters which take you towards a middle income and then a developed nation. So equity investing is a byproduct of that. The risk-taking ability of people has gone up. Young investors are more aspirational. They don't start off with a bank deposit as their first investment. They want to come to mutual funds. They want to come into direct equity. Some of them choose futures and options. So overall, there is a huge appetite to invest in the capital market. But I think one has to be cautious that a lot of young investors have not seen corrections or bear markets. They've only seen good times. That only bull markets, one way the market is going up. So one should temper the return expectations which are there. And as Amit rightly pointed out, you look at the nominal GDP growth, and then you look at the corporate earnings, and that could give you outlook of what are the type of returns that one can expect. The Nifty has returned 14% in the last 10 years. I think that's a fantastic return. And if you go down the market cap curve, the returns only get better. So as long as you are invested for the long term, you are not chasing quick returns. You are coming into a regulated environment, into a regulated industry, and you are giving money to a professional to manage. I think that takes care of all the wealth creation goals that an investor could have.
Right. Thanks. So I think both of you touched about that this cycle. There is a cycle and that has to come, right? It cannot continue unidirectional. And at the same time, how do we really kind of expect the risk? But coming back to you, Sandeep, a lot of investors have seen this again, going back to the same point, the unidirectional move, and that's where they think that the active fund manager is not so important, even if I remain in passive funds like exchange traded funds or like index fund, I will still make that money. Do you think the investor understands the risk of these funds, that they also behave in a particular manner when there is a downturn? What's your thought on that?
So in the Indian scenario that we are here today, majority of the money is on the active side. Passive side is growing, but it's still if you compare to someone like US, there it is 50-50. We are still far away from there. I think in the equity basket, 20% is on the passive side, but 80% is on the active side. But the risks, the market risk is there both on active and passive side. That does not go away by investing in a passive fund. I think the only advantage, the one risk that you don't take, a fund manager risk is taken away when you invest on the passive side, because the fund manager's call could be wrong, or maybe his investing style does not match the current cycle. So those things can happen. So that risk is taken away from there. But if the market falls, even the passive funds will deliver poor returns, and they will also correct, because they are just mimicking an index at the end of the day. They're replicating the index. So the investor cannot take it as a free lunch. They have to look at it as an equity investment, whether they are investing on the active side or the passive side. And they have to take care at what levels they are entering the market, which segment are they entering, and they have to always keep the time horizon and return expectations in mind while investing. So I think those rules don't change whether you invest on the active side or the passive side. And in the Indian context, I think both the styles of investing can coexist. There is space for both still. And I think in a typical equity portfolio today in India, still it's dominated by active investments. And maybe what we can see, what will change in the next few years, is that the passive side will gradually start moving up.
Correct. Yeah. Amit, you see that institutional investors, whether it's FIs or DFIs, they play a significant role in the construction of the market today, or the way the market is built up today. When it comes to investing strategies, how do you see the balance between the risk and reward, more particularly from the, maybe we can call it institutional investor, or maybe we can call it a very large HNI, UNHNI?
So when we speak about the Indian markets, what we have seen over the last 8-10 years, that many large institutional wholesale investors have come into the market. And the whole journey was started when our regulator, the pension regulator, EPFO, started investing into the market. And you will recount, since the time EPFO is investing regularly in the market, markets have become more liquid and more stable. After EPFO, we have seen many exempted funds coming in. There is a resurgence of family offices being formed in India, and many family offices are taking very active calls on the market. Now, when we look at their whole thought process, when we speak about these pension and provident fund coming and allocating a certain percentage of their corpus into the equity market, they generally come for very long term, and that is something which is anchoring the whole stock market in India. And to a large extent, we are being, staying aloof in terms of the volatility which we are seeing in the global market. But the liquidity is increasing by every passing day. The financialization of the Indian economy is gaining a rapid pace, and to that extent, we are seeing all sort of investor, somebody who is coming for a shorter term, taking a directional call for a quarter, 2 quarter, and then to the investor which are coming for 15, 20 years. And that is the whole evolution which is happening in the market. Sandeep also touched upon a very important point. We as a country are at the cusp of transition, and whenever we have seen any economy transitioning from $3 trillion to $5 trillion, the kind of financial market explosion which happens is unprecedented. There have been only 3 economies which have transitioned from $3 to $5 trillion, which is US, Japan, and China. And when you look at any of these markets, the capital markets have gone up by anything between 4 times to 16 times. That is on the stock market side. And even on the interest rate side, they used to come down by around 200, 300 basis points. So I believe we are at that very, very important level, the kind of economic expansion which is happening. We are the largest, fastest growing economy. I believe the better days are here to come. But only a word of caution, we should not be extrapolating short-term returns what we are seeing in equity market. Over a longer period of time, equity market will perform in sync with the GDP growth and the corporate profitability. And for investors who are taking their bet on the equity side should be doing their proper portfolio investment allocation. That is something which is extremely important. Another point that we used to be a nation of savers. We have become a nation of investors, and that is how we are seeing this 20,000, 23,000 crore kind of a SIP book which is coming in. But there is a large part of section of investors which have become speculators. There we need to handhold them. There are no free lunches in the market. More often than not, you lose your capital playing into FNO. And that is something which we are trying to imbibe into each and every investor, that investment is nothing but discipline. We should cut out the noise which is happening in the market, be disciplined in your approach. And the larger part of your returns are always back-ended. And that is how the power of compounding kicks in. The longer you stay in the market, the more money you make. And that is the kind of messaging we are giving to all our investors.
So coming back to you, since we mentioned that the passive funds are increasing in the market and the adoption is happening, one way is to tell or educate the customer what is happening in passive fund is that probably when there was an active fund management, you were trying to mitigate the risk of the fund manager by coming to passive fund. But the risk still remains there because the market risk is always there. You move from an individual risk to a market risk in terms of knowledge and in terms of way of investing. But if I have to, is there a new product you think which needs to be there in market in terms of innovation? Let's say if I start investing through quant or something like that, does it really reduce my risk? Or maybe the other way to put it is that, is the industry looking at more innovative retail products which kind of caps your risk in some or other manner, at the same time looks at the compounding?
Yeah, so our markets are evolving, and as the size increases, we'll have more products which will come in. And as investors become more mature, more sophisticated, they will try to look at products which can take care of returns and risk, not just chasing returns. So we are seeing that phase. Within passive products, majority of the assets under management are in the market cap weighted traditional products. As Amit rightly pointed out, that was front-led by the EPFO, and then it was followed by the retiral funds. And we have these large family offices who want some, beta capture in their portfolio, so they are gravitating towards index products. But there are also other products like smart beta products, which have been introduced in the last 3 years, where there is a factor which they are based on. Like smart beta factor, as they are called, smart beta funds, which are becoming popular amongst investors. So there are not only factors which target a return like a momentum factor, but also you have low volatility where standard deviation and is taken into account. The risk-adjusted returns are taken into account while shortlisting the stocks which will be selected under that particular index. You have a quality index, you have a value index. So yes, the investor is now, as they will mature, they will try to look at products where they will try to you can't minimize risk, of course. You will always have market risk, but you can reduce the risk overall, what is there, and the type of stocks that you want to invest in, the quality of stocks that you want to invest in. So there are a lot of funds where these parameters are there, like high ROE companies for quality, for instance, companies on the low volatility side where their beta is much lower than the market, they don't fall as much. So there are portfolios like that which are becoming popular. And yes, going forward, there would be more quant products where there would be multiple strategies which would be combined, and people will try to look at a targeted return and try to not have a lot of volatility. So currently, as Amit pointed out, because of the inflow of domestic funds which is there, our market is not as volatile as before. I mean, you have to bear in mind that, 1.5 lakh crores or 1,60,000 crores of FII money has gone in last 12 months, but 3,80,000 crores of domestic money has come. So that is why the corrections are very short. They are not what they used to be before. There would be 3 to 5% corrections at the most, and the cycles are very short. What used to be a 2 and 3 year cycle now has come down to a 3-month cycle. So that there is a bit of more maturity in our market, more stability. And with that, there is a need to look at products to take care of the risk. And most of the products which are there on that smart beta space, they not only look at returns, but they also look at the risk parameters before designing the product. So it's always the risk-adjusted returns which you are delivering, which you look at. And yes, I feel that as the market becomes bigger in size, such products will become more popular.
Thanks. So Sandeep actually touched upon the weightage of domestic FIs kind of getting over from the foreign institutional investor, which we were witnessing for almost last 4 decades. What's your view? Have we reached the right balance that we are kind of fully insulated, or we are partially insulated in terms of the FIIs, the foreign FIIs?
So Nitin, when we speak about our markets being protected because of the inflows we are seeing, we cannot be fully insulated. This is a global village. Every markets are connected with each other, and there will be, some kind of an impact if there are certain events which are happening in the global market. The only thing which we are saying is that we will perform better because we are driven by not only the domestic flows, but the domestic, strength which we are witnessing on the economy side. Now, just to give you a color in terms of how the whole ecosystem on the financial markets have changed, Sandeep mentioned about the kind of SIP money which we are getting every year. Now, we are speaking about 23,000 crore kind of a money coming every month through retail investor. Now, on top of it, I spoke about the retirement fund investing regularly in the market. That is another 6,000 crore coming every month from these kind of an investor. In addition to that, you have NPS, the new pension scheme. These companies are growing by around 25-30%. They are adding another 5,000-7,000 crore. And on top of it, we have insurance companies, PMSs, and direct investor. So what we are looking at, every month there is a gross inflow of around $4.5 billion coming our way, which translates into around $40 to $50 billion kind of a money coming in. And that is the reason when you look at FI's withdrawal, and there was a period from, say, October 2021 going up to May 22, where FIs withdrew $40 billion from the Indian market. It was 3,20,000 crore plus. This was a time when the whole inflation scare was there in the global market. I will tell you, the global markets at that juncture were down by anything from 20 to 50%. Nasdaq was down by around 35-40%. S&P 500 down by 20%. Same was the case in Europe. Not to mention the global dragon index in S&P, which tracks the Chinese stock, which was down by 60%. And that was the time we only fell 18% from the top. So no way we are saying that we are going to be insulated or not connected or not impacted by what is happening on the global market. But because of the inherent strength of our economy and the kind of consistent, sustainable inflows which we are getting, we are much better prepared, we are much better positioned. The only word of caution which we keep on saying is, please don't get carried away. Please have your proper investment plan in place, and make sure that you are investing through a staggered approach. Don't extrapolate returns what you have made in the last couple of years. Look at the longer picture. Look at compounding your returns over a longer term of your investments.
So I think in the interest of time, maybe I'll take up the last question, and that connects back to our opening question, that when you look at the macroeconomic indicators, the rising inflation, the geopolitical tensions, the interest rate cycle peak, how do you see the market? I think that's what the audience wants to hear. How do you see the next maybe a year or two?
So the Indian economy, the growth story remains intact. I don't think there is any doubt on that. And a lot of factors are working for us. If you see, oil prices have come off. That's good for us. We are one of the largest consumers of oil. And even the other macro factors that we have in place, whether it's corporate profitability, whether it's inflation, as you touched upon, which is not as high maybe as in other developed economies. And there is no dearth of growth stories in India, whether you can just see the pipeline of IPOs which have come in the last 2 years, the kind of companies which are coming in, and new age businesses are also participating in this. So I think the runway is very good for the capital markets. There's no doubt about it. Of course, professional fund managers will always look at valuations when they are investing in the stock market. Valuations are debatable, but growth is not debatable. Growth is here to stay. And if you are here to invest for the next 5 to 7 years, I think India still continues to be one of the best destinations. There's no doubt in my mind about that, because even from, as you touched upon, the geopolitical sense, post this COVID, a lot of developed countries are now moving away from China. China used to be the sole manufacturer for the world. Now the world is looking at alternatives. They look at Vietnam, they look at Korea, they look at Mexico. They're also looking at India. So you've seen, Apple making phones in India in a very large way, and more manufacturers are coming in here. We are manufacturing chips for computers in a large way for the first time. And even we are, in collaboration, maybe making fighter planes in India. So all these things are pointing to a very positive outlook on India. And I think that even if you are paying a slight premium in valuations, you should still invest in equities. You can stagger your investments. I think SIP is a great tool to invest. And I think most of the Indian investors have bought that. They should continue with that. And one should remain invested in such a market. I think the market growth potential or growth outlook will be in line with the corporate earnings and the GDP growth that is there. And I don't see why that should get interrupted. Of course, there can be a black swan event, like, what happened during COVID, where, our markets fell 25% because the global markets were impacted. So that is difficult to predict. But aside of that, I think the outlook is very positive, and Indian investors should continue investing via the SIP route. I don't see any change in that, and one should be overweight on equities.
Sure. Thank you. So on that note, I think we come to the end of this session. So the message which I get from both of you is that the power of compounding remains same. It's all about, when you look at your risk appetite, I think it's all time horizon, which makes or breaks the game. And I think with that note, thank you very much for being a fantastic audience. Thank you, both of you. It was
Thank you.
fantastic.
And if anybody has any question, maybe they can.
I think we have already run out of time.
Thank you, sir. We have a very pleasant task to perform. I again request my committee chairperson of Next Gen Packaging Committee to kindly come up to the stage, sir, and do the honor to Mr. Amit Gupta. To Mr. Nitin Jain, and to Mr. Anil Tadimoti. With this, we break for lunch, and can we have a group photo together? With we are breaking for lunch. ये बॉल चालू करते बंद करो चालू करो Good afternoon, everyone. I would request everyone to kindly take your seat, please. We are commencing the next session. I would request everyone to kindly take your seat, please. I would request my colleagues to usher all the people inside. We are commencing a session which is of huge significance. We'll be covering risk and fraud prevention in the financial services value chain. We have very eminent discussions with us. Mr. Rufar Rub, Director, FS Consulting, PwC, and Mr. Anil Tadimeti, Director, Strategy, Bureau Inc. I would request both of them to kindly come up to the stage, sir. And I would request Mr. Rufar to kindly progress with the session. We are just ushering all the people inside, but you can start. Thank you. Over to Mr. Rub.
Good afternoon, all. I think everybody had lunch, and it's a session which will keep our eyes and ears open. Something which is focused on risk and fraud in the financial services value chain. I'm Rufar Rab. I'm a director with PwC in the financial services consulting practice. I'm extremely honored to take part in this discussion in this financial market conclave organized by Bengal Chamber of Commerce, along with my colleague and friend, Mr. Anil Tadimeti from Bureau. He's a Director of Strategy in Bureau. So we would be discussing about our conversation focus around fraud and risk, especially on the lending value chain. So in the recent years, the financial services sector has gone through a huge transformation, and technology has played a key role in reshaping the lending landscape across the value chain, right from your lead, your sales, your customer onboarding, your processing, your disbursement, collections, payments. So technology has played a key role in transforming this entire value chain. However, the advent of technology also has brought in its share of risk and frauds, which is increasing tremendously. As per the recent report which has been published by RBI, last year we had around like 36,000 cases of frauds in credit cards and internet transactions, which is amounting to almost 26,000 crores, which was also, I mean, that's the previous year, which has reduced to 14,000 crores in the current year. So it really shows that, you know, the kind of compliance and the actions which has been taken by RBI on ensuring that, you know, compliance or risk is just not a back-end function, it is a board function. So I'll also have Anil introduce himself, and if you could speak something on what Bureau does from a fintech side in terms of handling all this risk-related, and fraud-related issues which is happening in the sector.
Thank you, Rufar, and thank you, BCC&I, for giving this opportunity. I know it's a post-lunch session, and usually, right, our energy levels drop. Let me begin with a question. How many of you know where do you report when a cybercrime has happened? To somebody you know or to you? What is the number you dial? Okay, I hear 1903. Okay, I hear 1930 as well. So 1930 is the right answer. To be honest, I'm a little disappointed to see the number of responses I received. From this audience, I would have expected a lot more. In fact, like Rufar mentioned, RBI is not just working towards, ensuring that the system is resilient, the system is clean. They've also spent a lot of money on ensuring that there's public awareness, right? So that is where I was coming from, because the reason is today, two things have happened, right? One, identity is no longer deterministic. Identity has become probabilistic because of, again, technology, data leaks. Unfortunately, the reality is that your data, Rufus data, my data, is available for 50 to 150 rupees on Telegram and other places, right? So that is where we come in. At Bureau, we actively try to prevent any kind of fraud happening, right? So fraud usually used to be post facto, right? And again, for compliance purposes, right, we want to change the paradigm. So we want to help institutions protect themselves from various kinds of emerging frauds, right? To give you an example, what we've been able to do is we've detected more than about 3 lakh money mules, right? This is just in the last 6 months with some of the customers we work with, right? And if you look at every top interaction from whether it's the RBI governor or elsewhere, money mule is the biggest problem in the financial system today.
From a regulatory compliance, when you speak about AML, at Bureau or any fintech, how do you classify this, the risk, and how do you, and these frauds, how do you classify it? What is the thinking behind it in terms of to classify this risk and frauds?
Yeah, so in my own experience, and then previously I was at the RBI, so I can speak from position of authority in terms of how that paradigm shift has happened, how that approach to fraud and risk has changed, right? In, let's say, the last 5-6 years. So earlier, again, what we would look at is probably more about mortgage related, about diversion of funds. If you look at major instances that have happened, in recent times, the shift is more towards the small value frauds, right? And even the RBI is cognizant of the fact that today it's no longer skewed in terms of just your credit related frauds, right? Payment related frauds, UPI related frauds, they've in fact taken over in terms of number. In terms of value, obviously that will still be smaller, right?
Right.
So what we've seen is that organizations are coming forth in order to ensure that their systems are not only compliant, they're actively thwarting any threats that happen, right? So it's not just for regulatory compliance that because RBI says you need to have, let's say, a fraud monitoring, tool, I'll employ that. But I can go beyond that in order to protect myself and obviously in some cases customers itself, right? Because today what is happening is it's again shifting from the, let's say you used to have a large amount of especially in housing or some of those, right, secured assets, that's where there would be some tampering of documents, all those things, right? Today it's more about the identity itself, right? Like I began. Now, fake ID cards, stolen ID cards, right? These constitute at the onboarding stage itself at least about 60% of frauds that happen, right? But it's only when lending happens, then somebody goes for collection, they realize that that person doesn't exist, that person doesn't stay where, they claim to be, right? Because fraud is about intent, right? Fraud is not about the ability to repay, if you talk about lending, right? So therefore, the focus has to shift from looking at purely financial data and financial statements to understanding behavioral aspects of the prospective borrower.
Right. And also to add that the entry for the fraudsters, there are different layers as well in the financial services. If you look at the lending chain, for example, it could be at a payment level, or it could be at an application submission, or it could be a push message for paying your EMI installments. So there are different layers which is comfortable for fraudsters to kind of attack on the. So it is important to kind of note that this entire risk policies or risk mitigation mechanism also has to be taken into cognizance of the fact that how is the lending chain being
enforce with security without impacting the customer experience also, because customer experience is the key. I mean, the moment you have some authentication which is coming in, there is a friction in the journey which is coming in, which the customer is not liking it. So without impacting that, how you can take care of that risk is also something which financial services players is actually working on, especially the fintech players bringing out innovative solutions is also something which we need to talk about.
Thanks, Rufar. You brought out an amazing point, right? So I'd mentioned about identity risk and how you can track behavior to understand what the identity risk is at any point, right? Let me elaborate on this. Now, fraudsters, if you employ any rule-based system, fraudsters are quite quick to understand what the loopholes are and to exploit them. We've seen numerous instances where even mobile applications get cloned, get tampered with, and then because you have policies, right? If you were, say, 10,000 rupees below that, you will just take, let's assume, one OVD, you will do, a digital KYC, any of those. If it's more than, say, 60,000, obviously it has to move to, right, a video-based KYC, a digital, right? Or you need to have in-person verification, as the RBI puts it, right? The fraudsters are quickly able to do this, and then it's already shared. Like if you go to YouTube and look at some of these, right? How do I get quick money? How do I tamper somebody else's data? So what we are trying to do is look at attributes that can't be mimicked or replicated, right? For example, one thing that we've done very well is understanding your digital footprint, because whatever we do in the physical world today leaves an imprint in the digital world, right? For example, I've had the same phone number for about 17 years now, right? I've had the same email ID for about 15 years now. So all these are indicators of trust. Now you look at, there's a lot of talk about how you can use alternate data. The advantage with alternate data is that, especially in the non-financial aspect, is that the fraudster will never get to know which algorithm is being triggered in order to accept or reject the application, right? For example, if I do a digital footprint, let's say how many social media platforms are you present on, how many travel platforms, everything that you do on a daily basis, right? You'll use some ride-hailing cab, you'll use, OTT platform, you'll use a delivery app. But I can get a fair sense of what your digital persona is. From that, I can attribute what your real-world behavior is. Because we've seen a number of instances where, for example, that social media footprint is quite low for fraudsters. And in fact, a curious case where, while this is true, you will still see some presence on payment platforms because they need to get money out, right? For money to come in and go out, they still need some of those applications present. That's a clear telltale when you look at how it varies between a genuine user and a fraudster.
To understand this difference between the genuine and a fraudster, I'm sure that fintechs are using AI and ML as well in terms of understanding the behavior pattern. So how is it happening at the back end? If you could just throw light on it in terms of what kind of technologies in terms of AI and ML, how is it leveraged? How are you leveraging it?
I'll give a simple example. We have bankers, we have other participants from BFSI. So you would know that any suspicious transaction that you notice, you have to report to the FIUIND, right? Now, if you look at the stats, FIUIND receives about 4 lakh STRs, that's suspicious transaction reports, per year. Do you know how many alerts are raised internally for this? Take a guess in terms of, it's at least 1,000 times of this. Right? The reason is because most institutions still rely on traditional ways of trying to identify anomalous transactions, which means they use rule-based systems, right? Rule-based systems, obviously, as you can see in this case, come with a lot of false positives, right? They also add to a lot of operational hassle because just to process those alerts, you'll probably need a team of 30 analysts, right? Sitting and looking at which one is genuine, which one is suspicious. What we've been able to do is through ML, we've made those rules adaptable and smarter, right? Which means the models get precise over a period of time. What we've also gone and done is, in reality, anything to do with AI ML can never be fully explainable, right? What we've tried to do is make it as transparent as possible so that whether it's the customer, whether it's the regulator, they have a clear understanding of what is going in, right? It's not just about what is coming out. In fact, the RBI just recently issued guidelines on ensuring that you are not relying only on black box models.
Got it, got it. So just to add to when you mentioned about the regulator, so there is a lot of data which is coming in and going out, when you are integrating your platform with a financial services player. So how do you ensure data protection and ensure that you are complying with the guidelines of RBI?
Yeah, that's a fair question, and to be honest, it's not just about the RBI, right?
Yeah.
Now, with the Data Protection Act that's about to come into vogue, the act is being passed, we're still waiting for the rules. The power, in fact, is going to people like us, right? Because we are the owners of our data, right? And not necessarily any other player in this, right? So the first thing starts from, do I have a need and the right to obtain certain data, right? First pass that check, right? Which means I take specified explicit consent for the data I'm procuring, right? The second aspect now, once I've obtained that, what do I need it for? How long do I keep it? Who do I share it with, right? These are the next level of questions. So ensure that you are at the time of data collection, right? You have top-notch standards. The data is encrypted, whether it's at transit or rest. Once it's into your system, how do you use it, for what purpose? Limited to that. And then third is, once that purpose is served, unless there's a regulatory, again, prescription on how long you need to store the data, then dispense with it or purge it, right? The biggest forms of vulnerabilities, in fact, come from storing data that's no longer required. So we, as somebody who is typically a data processor in this case, right? We are not a data fiduciary. Banks, NBFCs, they'd be the data fiduciary and the data principal, right? That's the arrangement between them. So we ensure that our customer, that's the data fiduciary, has obtained the necessary consent. We follow the same standards. We are not a regulated entity, we are not a bank, but we follow the same standards that would be applicable to a regulated entity when we treat any personal information.
That's a valid point. So, I mean, there are a lot of points which you just mentioned in terms of the data bit, in terms of what you store and how much do you take and what is it relevant at what stage. So, typically, what are the challenges you see when it comes to a fintech integrating with a financial services player? What kind of challenges you come across in terms of this integration and all sort of things?
So the first thing is, when you talk to traditional institutions, right, their data is in silos, right? Now look at how solutions are orchestrated on data, right? Which means that you need to have right data, you need to have meaningful data without garbage, right? So usually, if I'm looking at, because let's assume there's a bank, there'll be at least about 20 different loan journeys or loan products that they have. There'll be similarly on, the deposit side, there'll be about 10 of them, the different kinds of schemes they run, right? So there is no single view of the customer journey within that institution, right? And I'm not even talking about what the customer has done outside that, right? That becomes the biggest stumbling block, whether it's for a fintech or for, in this case, a financial institution, to understand what the underlying patterns are and to form that holistic view, right? So, and typically, the other thing that happens as a result of this siloed approach is, it's not just that the data is fragmented, the outcomes also become suboptimal, right? Because these systems don't talk to each other.
So when it comes to the DPI, how is it supporting the interoperability between the NBFCs and banks, the common platform which is coming at, So how does that support a fintech?
So just continuing on what I mentioned earlier, right? When you're dealing with data, and of course, the one advantage, the way I see it, is banks have access to a lot of data, right? Because you have your accounts with them, they understand transaction patterns, they can now create models in terms of what your ability to pay is, right? One thing that DPI has done, especially with, let's say, Aadhaar, right? Aadhaar has made digital onboarding seamless and possible, right? Not that it doesn't come with certain risks, but we understand what those are, and then we can play within those boundaries. But an account opening process, which would earlier take about 48 to 72 hours, today is a matter of 10 minutes, right? So that is on the identity layer, right? Next, if you go to the transaction layer, with payments data coming in, right, it makes it easier, faster to underwrite, right? And it's not just about this, the other aspect which you touched upon earlier, right, in terms of how customer behavior also has changed, right? Customers look for convenience, customers look for instant credit. So you can't keep asking the customer for each piece of information that you need. Can you submit your PAN? Can you submit your Aadhaar? Can you submit your salary slip? Can you submit your bank statement? And there is something that's come out now which can integrate all of them, right? We are now talking about the account aggregator, which serves as the one-stop shop, at least in terms of, sharing that financial data. It's not just about sharing financial data, it's about sharing authentic financial data, right? So these are ways in which DPI can actually has, at least in the last decade, proven to ease customer experience, right? Also help fintechs, institutions. You have hundreds of fintechs who are just built on DPI stack, right? Whether it's the India stack, whether it's the upcoming technologies. What I'm most hopeful about, in fact, is the recent announcement made by the RBI governor on democratizing credit by launching the unified lending interface, right? Once you have that data come in, the needs, in fact, we had this session earlier on insurance under penetration, all of those would also change once you have more of this data plugging in. Right?
So just to add on to that, in terms of the operational risk also, it is something, as we see that the digital secured lending, there is a digital unsecured lending, there is a shift which is happening to the secured lending also. If you see that the banks are having more branches opened up, NBFC is going left, right, and center in terms of opening them to the Far East and other locations which has not been covered earlier. So if you look at from an operation standpoint of view, there are a lot of, again, when you go to secure, there is a bit of physical transaction which is coming in, and it requires a customer touch point, right? So that has a necessity for operations to come in as well. In the typical financial services play, having a standard operating procedure in terms of how a process is being started or how a process is ended, having a right roles and responsibilities which has been identified for the employees in terms of who is collecting applications, what is the role of an underwriter, underwriter starts from which process and ends with whom, whose authority was approved. So there are a lot of areas which is coming in as well in terms of having a robust IT infrastructure. For example, we also heard about the regulator cancelling a particular product of a leading bank because of their IT-related issues which they are not able to, having hiccups in their transactions. So regulator is also pretty strict in terms of or cognizant of the fact that what kind of service disruptions are happening in the operation space. So there are, if you have right set of controls in place, internal audit controls, and more importantly, rather than being reactive, being proactive, monitoring those risk parameters, having KPIs identify the root cause and get that fixed, and it won't work out just by having a system in place. It is more to do with awareness among employees as well as with customers as well. In terms of employees, I would say how to report, when to report, whom to report, how a case has been identified, how that has been taken care, or how it has been addressed as a closure. For a bank's perspective, there is different guidelines which is going in terms of the reporting which has to go to the regulator. But NBFCs also will have to, kind of implement these kind of best practices so that these risks are also addressed. So just looking at from an operational risk standpoint of view also, there are different control mechanisms which can really handle this, vulnerabilities which comes in the process across the lending value chain. For example, in terms of you identify the customer, get the customer identified right in the first place itself, whether it's a right customer to lend or not, right? And because your credit risk is coming in, your market risk is coming in. For example, in terms of gold, you lend it and, the value of the gold went down and the LTV is breached. So you take cognizance of the fact that, the risk has been monitored on a regular basis so that, you take appropriate actions for it. So, you want to add some points to it?
No, I think you've touched upon a brilliant point, right? We've spoken about one fact that regulatory risk perhaps is the biggest concern today and it outweighs any form of credit risk, market risk. But just on a couple of things that you touched upon, right? We all seen that lending is easy, collections is hard, right? So that's where I believe that now that synthesis or collaboration between fintechs and BFCs can happen, because fintechs are technology driven, right? They understand how to use technology for automating, for making processes efficient and effective, right? But traditional institutions with their wisdom of understanding whether it's the underwriting process, whether it's the collection process, now both can work together and make sure that the risk is contained at each stage, because fraud is present in every stage of user interaction.
Yes. So having the right policies integrated into the lending chain, without impacting the customer experience would be the key message, basically. I think thank you all for joining us for this discussion. I'll hand over to Arnab.
Thank you, Rufa. Just before we conclude the session, we have come across from the days where I remember from reading a book of Mr. Tamal Bandyopadhyay, who was there moderating, that there was a time when people used to lend the consumer, like if they have requested for a particular loan and the paper has to be put under a photo of a goddess, and if any flower will fall into the paper, the loan will be sanctioned, otherwise it's not going to happen. So from those days we have traversed to the days of fintech and all. So with this note, I would request our chairperson of the banking committee, Mr. Ranajay Basu, to kindly honor us with his presence at the stage and give the memento to Mr. Rufa Rab. And to Mr. Anil Tadimeti. Can we have a giant photograph, please? Usually we give a break for commencing a new session, but since just already we have lunch, we are immediately switching to the next session with Mr. Abhijit Shah. It's very important for us to understand that the session would be on the modernization of investment business, what consumers need to know. Now, in the age of when we have enormous number of apps, when we have every information available via AI tools, still there are certain things as a consumer which you need to know, which are hidden. And I'm sure that as a musician, Mr. Shah would be opening his sleeves, and let's see what it comes out from. Over to Mr. Abhijit Shah.
Okay, thank you, Arnab. Good afternoon, everybody. Good evening, between afternoon and evening. So, usually the last session is very, very, very difficult. I'm not going to keep you with a lot of boring stuff, but just talk about what are the key trends that have been guiding our industry, what are the key trends guiding investments, etc. Right? So clearly, I mean, today, if you see mutual funds or investment or investing or markets or, planning, financial planning are a mainstay discussion whenever we go. I mean, it's a coffee table discussion, it's an evening discussion. In fact, when I go in my building and when I'm in the elevator, I think 10 years back or 15 years back, when I said I work for a mutual fund or I work for an investment firm, people used to say, "Haan, theek hai, ye kya hota?" But today, the moment I say I work for a mutual fund, in fact, across age groups, people are asking, "Ki sir, kaun sa lena chahiye?" Right? Ya to, it's like that Maruti ad where everybody is interested, kitna deti hai. Suddenly, everybody is so interested in investments. And, one has to look back. So, I'm sure people have looked at a lot of data. 10 years back, this industry was at combined assets under management at 10 lakh crore. Today, that number is about 66 lakh crore. So that, it's almost from 10 lakh to 66 lakh crores. 10 years back, our number of customers as an industry were close to 1.5 crore. Today, we are close to about 5 crore customers. In terms of folios, there are 20 crore folios. Out of that, 16.5 crore folios, which are account equivalent for mutual fund from a banking parlance, are about 16.5. 16.5 crore folios are only retail. And this is possible only because the Indian consumer today is taking investments or looking at savings to be invested in forms of non-traditional asset classes like mutual funds. Of course, there is a huge talk in the papers every day. You see that the savers are becoming investors, right? And that is a reality. Because as the GDP or per capita income of a country goes from $2,500 towards $5,000 across the globe, we see that savers actually become investors. This is largely because the needs of consumers also modernize. The needs of consumers also are becoming different. Earlier, Arnab just spoke about how the lending process used to work and people praying with a form, flower falling, etc. So imagine the plight of the consumer to get a loan. But today, everything is on tap, on mobile. Fintechs are driving the growth, credit growth to such an extent that one can switch from one loan to the other, look at it, compare, etc. So the role of digitization, the role of digital is really shaping up how consumers are making their journey. Also, what has happened is, as the per capita income of the country changes, basic needs like, food, housing, shelter being taken care of, discretionary needs really set in. So, if you look at when most of us in my generation started working, the first aspiration was, to kind of look at buying a house. And a lot of us actually bought a house and, ended up paying the EMIs for a long time. A lot of us are actually paying EMIs today. But the generational shift that's happened is a lot of youngsters who are coming into the jobs, a lot of youngsters who are more confident today are believing that, hey, look, it's not about taking a loan, buying a house and, just working for one company for a long time and retiring. The discretionary needs are, people are looking at buying a new iPhone, people are looking at, experiences, especially after COVID, people are looking at, taking more holidays, wanting to post on Instagram, etc. So as the goals change, people are really taking modern investments like mutual funds or alternative investments like mutual funds or investing in the markets very, very seriously. What's also changed is the availability of information across the board. And thanks to digitization, thanks to digital, today the amount of information that is available on investments, the amount of information that is available in terms of financial planning, the role of mutual fund advisors, bankers alike, has really made it possible for the Indian consumer to take personal finance in a very serious manner and own it up. Earlier, it was largely about somebody recommending an investment option or somebody telling me about what fund to buy. But today the amount of research that is available, both from an intermediation point of view and the digital point of view, is really driving the consumer shift towards a more informed, more researched, more advanced and more modern decision-making process. Of course, the fintechs have played a large role in terms of making the user journeys, making the investment journeys so easy, combined with the authentication journeys that we speak about, thanks to India Stack in terms of the Aadhaar authentication or a PAN-based authentication, payment journeys. Today you can actually start a SIP or buy a mutual fund using UPI, using a barcode scanner. So all that come together has made the decision-making process as well as the purchase process so seamless that, in fact, we were trying to time, it is easier to, or it is faster to buy a mutual fund on any mutual fund app or through a distributor than actually order a mobile phone on Amazon. And of course, it takes more time for the phone to come home and then the NAV to be allotted the next day or the day after, depending upon bank holidays and all. The redemption process, it is so easy today that, and I'm not trying to compare various products or various traditional instruments, but because of the information available and because of the decision-making process being so digital and the transaction process being so seamless, it is so easy to actually know what the value of my investment is at any point in time. And the same time, whenever one needs money, just at a click of a button to redeem that money. In fact, there are funds on the overnight side where there is overnight funds and liquid funds. Most asset management companies offer that product, and investors should definitely look at is the instant redemption facility that is available on overnight funds. So, gone are the days where one has to really wait for giving a transaction slip, being authenticated by the bank or the mutual fund company, then getting it time-stamped before 3:30. I mean, here you can actually redeem at any point in time and get an instant credit the same day up to 50,000 rupees, which is a good amount if one needs to look at from an emergency fund utilization point of view. Lots is also changing on the alternate investment side. So earlier, it was only about starting an SIP or looking at a mutual fund. But as the values of portfolio grow, a lot of mutual fund companies or asset managers, and you look at the number of PMS or AIF licenses that have been taken in the last 3-4 years, is a testimony to the fact that consumers today are looking beyond a traditional or a straight-jacket product, because in a PMS or AIF product, the structuring or the decision-making between the consumer and the manufacturer is very evolved, and that really drives that growth also. Of course, the role of marketing, the role of customer experience, the role of digital is immense. I think if today you go to any Instagram handle or if you go to YouTube Shorts, I think there are more people talking about what one should do with personal finance than people trying to do, trying to tell you how to cook a biryani or cook a samosa, because, and that's again guided by the consumer demand. End of the day, it's a platform, it's user-created content, and users create the content that is being viewed by users. And the data that we get, today, if you see roughly about 65 to 70% of our new customers are youngsters. And when I say, if you break that down, about most of those customers come from the age bracket of 21 to 30, all of them actually, in the new customers. So, and within that also, we are getting a third of that customers come between 18 to 24. So an 18-year-old, 24-year-old actually looking to start an SIP, actually looking to look at mutual funds from a financial planning point of view is really growing. And that's really driving the whole content around mutual funds, the whole story about what mutual fund should I choose, what are the parameters one has to look at while looking at choosing a mutual fund, various calculators that are there, various interactive tools which allow people to set their goals. So it's almost like, if one has to get fit, one has to run a marathon, then there is a whole plan around what are the steps to be done. So if one has to get financially fit, there are a lot of tools and plans, etc., available online through mutual fund distributors, through fintechs, etc., which consumers are looking at and consuming to say that by this age I need this much corpus, by this age I need this much corpus, and this is the kind of investment I'm going to do, this is the kind of risk parameters one is going to look at, and this is the kind of financial planning or goals one has to achieve. I'd like to also talk about the role of what as an industry we have achieved, right, in terms of how the whole category creation has been successfully been established by Association of Mutual Funds of India, and all of us have seen the Mutual Fund Sahi Hai campaign, right? So that's one of the campaigns that across channels, across TV programs, across media, across hoardings, the whole intent of educating people on the category to look at a modern investment product has also made it really beneficial for customers to take the right kind of decisions. So these are the various things that we believe are driving our force and are the driving force for mutual funds in India. I think what I would like to do is also show you a short video in terms of how Mutual Fund Sahi Hai as a campaign, and because of the consumer pull and the category creation done by AMFI has really resulted into mutual funds being the mainstay product in today's consumers' financialization journey. So we can play the video. There's one more video. Yeah. I think we should play the video. There's a common video also. It's a long. There are two videos that are common. Okay, anyway, I think there is some. So there was a video that was continuing which talked about the campaign of Mutual Fund Sahi Hai, but I think it's not there. Anyway, I'm not going to bore you on that because even if you don't see it here, you will see a lot of Mutual Fund Sahi Hai ads coming out of all TV programs, right from Sachin Tendulkar to Dhoni to now Rohit Sharma talking about Mutual Fund Sahi Hai, and it was a very nice ad that came in. I'm sure a lot of people looked at where we tried to capitalize on the forgetfulness of Rohit Sharma, where he says that, where Dhoni and Tendulkar take a dig that, hey, look, this is ये तो phone आपका है, तो ये phone तुम भुलाए थे, ऐसे ही आप retirement planning करना मत भूलना. तो to which he kind of retorts and comes back saying that, नहीं retirement planning मैं भूलता नहीं हूँ कि उसके लिए मैंने SIP कर रखा है, right? So lot of that communication, lot of those ads, I think I just had a package to show that, but I'm sure that wherever you say Mutual Fund Sahi Hai, we will bombard you with about 10-15 different ads of Mutual Fund Sahi Hai. So that is it from my side. And thank you very much. If there are any questions, if there are any thoughts, I'd like to open it up for people. Yeah. Yes, sir. Sorry. Yeah, somebody behind, so I can't. Sorry. Yeah, ONDC, that's a very, very important part. In fact, as an industry, we are working at it at the Global FinTech Festival. A couple of manufacturers, including us, spoke about it. But very soon you will see there is a huge ONDC integration right from not only on the distribution side, but on the consumer side, where people can discover various mutual funds or distributors, so that the whole penetration of mutual fund distribution will start. So that project is underway. In fact, ONDC is also working along with Association of Mutual Funds of India to look at the whole pricing structures or regulatory structures, so that this project is penetrated highly in the country.
Yeah, thank you. Recently seen Nippon might be, doing some testing on the ONDC side. So what is your timeline inform?
Sorry, Nippon?
Nippon, India.
Yeah.
So they might have tested into
Yeah, they
ONDC.
tested a transaction. We also tested. I mean, and a lot of other AMCs have also tested. While we didn't showcase that at GFF, but all of us are in the journey to integrate with ONDC, and most mutual funds will be live on the platform.
So are we expecting in 2025 to be that live?
I think 24.
24, yeah, thank you.
Yeah.
That's
I mean,
great.
as we speak, maybe 24 days, not 24 also.
Sure.
Yeah.
Thank you.
Hello. Sir, how are you? Seen you after a long time.
Yeah.
So, Dinesh this side.
Yeah, hi, how are you? Yeah.
Ex-ICICI AMC.
Yes, hi.
Hi. So, right now started new business, launching my distribution channel app and website in a month. Okay. So, looking to know like what would you see the future of distribution channel like in tier cities? Like cities are already captured by banks, major distributors.
No, yeah, definitely. I mean, that's a right question, and I think the whole industry is banking on people like you to start an entrepreneurial journey to go. And if you are focusing on tier 2, tier 3 cities, that's where the action is. So just to give you some data, I'm sure you know it more than a lot of people, that in a country with 1.4 billion people, about 80 crore bank accounts, 45 crore insurance policies, 110 crore mobile phone connections, all put together today also on a unique basis, we are only 5 crore mutual fund holders or customers. So the future is as bright as bright, because that's where the next wave or the next crore or next 2 crore customers are going to come out. And from a consumer demand point of view, if you see, because of digitization and because of digital, today a customer in Tinsukia or a customer in Barabanki or a customer in a village outside Coimbatore is as empowered as a customer in Mumbai, Calcutta, Madras, or Chennai, because YouTube is common, Instagram is common, right? www is common. The way telecom companies, and we are the country with the cheapest data available in the world. So the phones are also common. Everybody's got a smartphone. So people, both the consumers are consuming the same amount of content, same amount of information, and there is same amount of interest towards financial planning, towards progress, towards ensuring that one has a good retirement corpus or has a better house or better standard of living, and everybody is looking at mutual funds. So that's the gap that people like you can actually fulfill. So we are very bullish on people like you helping us to go from village to village or tier 3 cities and getting us more customers.
Thanks. I believe ICICI has provided a great insight and development in my earlier days. One more thing, sir. The new product that SEBI has given permission of 10 lakhs of in derivatives trading, that do you know what we expecting as a client base? When can we expect that? And like,
yeah, so it's a good consultation paper right now, as you see, and this is where people are giving their opinions and about. So basically, either there is a 50 lakh plus product, or there is nothing. You can start. So this 10 lakh plus is a good segment, and a segment that can be catered to, where people are aware of the risk, are wanting to be more participative in the risk, and understand the risk profile. So that's for them. It is not. You got to also see that it is not like a straight mutual fund product. So there is a segment that is warm for these kind of products, and there's definitely a huge scope for this product.
yeah, people are looking for this product because mutual funds, PMS and AIF, nothing in between.
That's how. If you see regulator, which is, SEBI has been the most proactive regulator when it comes to market development, product development, transparency, customer insights, customer experience, etc. So this is definitely coming through researches or consumer needs, and hence this kind of a consultation paper to fill that need gap.
Thank you, sir. Is there any other question that you're having? Okay. With this, we conclude this session. I would request Mr. Ranajay Basu, the chairperson of the packaging committee, to kindly come up to the stage. I'd request to kindly give us the memento.
Yeah. Thank you. And Arnab, to your query, I'll handle that query.
Okay.
Sorry, just for the information and transparency, while I was speaking, Arnab sent me a WhatsApp saying that, I'm facing some difficulty in redeeming a mutual fund. So to which I said, before I go, I'll solve that query and go. Thank you. Thank you.
So, as we come to the conclusion of the conclave, we formally conclude the Financial Market Conclave in 2024. We are really grateful for all the participants for staying with us and addressing kind set of questions. Please do email us if you want to connect with any of our speaker regarding any questions. We'll come back to you via our email, and that's all from our end. Goodbye. Thank you.